Welcome to the program. We are going to explore the framework of the Certified Regulatory Compliance Manager credential and the core competencies required to successfully navigate its extensive curriculum. This content is for informational and entertainment purposes only and does not constitute financial or legal advice. Always consult a qualified professional before making financial or legal decisions. This is an unofficial, independently produced course and study guide. It is not affiliated with, endorsed by, or connected to the American Bankers Association, ABA, in any way. All trademarks belong to their respective owners. This course is meticulously designed to transform your understanding of the regulatory landscape, providing you with a definitive advantage as you prepare for the American Bankers Association exam. We will systematically break down each functional domain, ensuring you grasp the intricate connections between statutes, supervisory guidance, and the practical application of compliance risk management. By mastering these modules, you will not only gain the technical knowledge to pass the test, but also cultivate the strategic mindset necessary to govern complex banking operations effectively. I encourage you to leverage this curriculum to bridge the gap between abstract regulatory theory and the realities of modern enterprise risk management. To earn the CRCM designation, you must first navigate the rigorous application process, which requires verification of your professional experience and a firm commitment to the American Bankers Association Ethics Code. The examination structure is heavily weighted towards specific domains, necessitating a disciplined study schedule that accounts for the depth of topics ranging from lending regulations to sophisticated anti-money laundering frameworks. We will examine how to prioritize your study time by evaluating your existing strengths alongside areas that require intensive focus, ensuring you optimize your limited preparation window. Understanding the weighting of each section is essential because it allows you to allocate your cognitive energy toward the legal standards and examination manual procedures that appear most frequently on the assessment. The curriculum moves beyond mere memorization by teaching you how to analyze audit testing parameters, risk assessment methodologies, and the nuances of board reporting metrics. We will dissect the architectural components of robust compliance management systems, emphasizing the importance of policy documentation, workflow controls, and precise threshold computations. You will learn how to approach regulatory change tracking and the subsequent integration of those changes into your institution's existing enterprise risk framework. This holistic view is intended to help you understand why certain controls are mandated and how they interact to minimize consumer harm and prevent enforcement actions. Finally, we will discuss the practicalities of examination management, including how to handle regulatory inquiries, draft defensible responses, and conduct forensic root cause analysis when issues arise. You will explore the intricacies of third-party vendor oversight, statistical validity and quality assurance sampling, and the life cycle of complaint tracking and resolution. By the end of this journey, you will possess a structured methodology for internal auditing and corrective action planning that aligns with strategic business goals. My objective is to provide a clear, factual, and rigorous foundation that supports your professional evolution as a compliance expert. I look forward to our progress together in the upcoming segments of this course. Welcome back. Let us now begin our deep dive into the Truth in Lending Act, known as Regulation Z. This chapter will cover the foundational requirements for mortgage disclosures, consumer credit protections, and the mechanics of APR calculation. The Truth in Lending Act, or TILA, represents one of the most significant pillars of consumer financial protection law in the United States. Its primary objective is to mandate the clear disclosure of credit terms so that consumers can effectively compare different lending products. When we talk about Regulation Z, we are referring to the specific implementing regulation issued by the Consumer Financial Protection Bureau. As a certified regulatory compliance manager, you must internalize that TILA applies to almost all forms of consumer credit that involve a finance charge or are payable by written agreement in more than 4 installments. This scope includes both open-end credit, such as credit cards or home equity lines of credit, and closed-end credit, which typically refers to installment loans like traditional mortgages. Understanding this distinction is the first step in ensuring your institution maintains accurate documentation and disclosure workflows. The regulation requires that lenders calculate the annual percentage rate, or APR, using a precise mathematical formula that incorporates the finance charge and the amount financed. If your institution fails to accurately disclose these figures, you risk significant regulatory scrutiny and potential civil liability. The introduction of the TILA-RESPA integrated disclosure, commonly known as TRID, fundamentally changed how lenders interact with residential mortgage borrowers. Under these requirements, creditors must provide a loan estimate within 3 business days of receiving a loan application. This document is designed to provide the borrower with an early look at the loan terms, projected payments, and closing costs associated with the mortgage. Further along in the process, the closing disclosure acts as a final statement that must be provided to the borrower at least 3 business days before consummation. For a compliance professional, the critical detail here is the rigid definition of what constitutes a valid change in circumstances that would necessitate redisclosure. You must monitor these timing requirements closely, as procedural failures in delivering these documents represent significant audit risks. The TRID framework also highlights the necessity of robust systems that integrate loan origination software with automated compliance checks to ensure all figures reconcile. Any discrepancies between the loan estimate and the closing disclosure require a documented explanation to satisfy examiners during an on-site review. Beyond standard mortgage disclosures, TILA addresses predatory lending through specific protections for high-cost mortgages under the Homeownership and Equity Protection Act, or HOEP. These rules place strict limitations on the fees and points that a creditor can charge, as well as mandatory pre-loan counseling for borrowers entering such agreements. Similarly, higher-priced mortgage loans, or HPMLs, trigger their own set of requirements, including the mandatory establishment of escrow accounts for taxes and insurance. You must also be intimately familiar with the ability to repay and qualified mortgage rules, as these define the regulatory safe harbors for mortgage lending. An institution must demonstrate that it has reasonably assessed the borrower's income, assets, and debt obligations before approving the loan. The record retention rules demand that you keep evidence of these assessments for a minimum of 3 years after consummation for most mortgage loans. By maintaining these controls, you effectively minimize the risk of consumer harm and demonstrate a commitment to fair lending practices. Looking at open-end credit, such as credit cards, the Card Act added sweeping changes to how issuers manage billing cycles and periodic statements. Creditors are obligated to provide clear information regarding interest rates, late fees, and the consequences of missing payments. Billing error resolution procedures are strictly codified, requiring banks to promptly investigate and address customer inquiries without imposing undue burdens. Advertising also falls under the purview of Regulation Z, particularly when it comes to trigger terms that necessitate clear and conspicuous disclosure of all associated costs. If your marketing materials mention a down payment, a specific payment amount, or a finance charge, you are almost always required to disclose the APR and other loan terms prominently. From an audit perspective, testing these advertisements against internal policies serves as a primary control against regulatory enforcement. Managing these risks involves consistent training and independent third-party oversight of all consumer-facing communications to ensure compliance across all marketing channels. See you in the next lecture. Welcome to the chapter on the Real Estate Settlement Procedures Act, or RESPA, as implemented by Regulation X. In this section, we will systematically deconstruct the core pillars of residential mortgage compliance to ensure you are fully prepared for your certification. RESPA was enacted primarily to provide consumers with greater transparency regarding settlement costs and to eliminate various abusive practices that drive up the price of home ownership. If you master the mechanics of Regulation X, you unlock the ability to navigate the most complex aspects of mortgage lending with confidence and precision. This course is meticulously designed for the rigorous demands of the CRCM exam, focusing on the statutes, agency interpretations, and examination manual procedures that define high-stakes regulatory compliance. By engaging with this content, you will gain an intimate understanding of how to structure compliant processes that survive the scrutiny of even the most stringent examinations. We move beyond superficial definitions, digging into the practical application of risk assessment, audit testing, and the nuances of loss mitigation. This is your foundation for building a robust, defensible compliance posture in a highly litigious regulatory environment. At its core, Section 8 of RESPA is a prohibitive statute that targets kickbacks, referral fees, and unearned fee arrangements that distort the competitive marketplace. The rule is broad by design, prohibiting any person from giving or accepting any fee, kickback, or thing of value for the referral of settlement service business involving a federally related mortgage loan. This extends to split fees where no commensurate service is provided, which the regulators view as an unearned fee. An affiliated business arrangement, or AFBA, serves as a narrow exception to these prohibitions, provided that specific stringent conditions are met. To qualify for this safe harbor, the referring party must provide a mandatory disclosure to the consumer. The consumer must not be required to use the affiliated service provider, and the only thing of value received from the arrangement must be a return on ownership interest. From an audit perspective, you must confirm that these disclosures are not only present, but provided at or prior to the time of referral. Failure to document this properly creates a glaring point of vulnerability in an examination, often inviting deeper scrutiny into your third-party vendor oversight programs. Beyond referral prohibitions, RESPA establishes precise requirements for the management of escrow accounts to shield borrowers from unpredictable surges in housing-related expenses. The rule establishes strict limits on the amounts that lenders may require borrowers to place in escrow, calculated by an aggregate analysis of the anticipated disbursements throughout the year. You are mandated to perform an initial escrow account analysis at settlement or within 45 days, followed by an annual analysis to ensure the cushion does not exceed 1/6 of the total estimated disbursements. If an analysis reveals a surplus of $50 or more, the lender must refund that amount to the borrower within 30 days. Conversely, if a deficiency exists, the lender may choose to require the borrower to pay as little as 1/12 of the deficiency over a 12-month period. These calculations represent a significant point of failure for banks with legacy systems, as slight errors in input variables cascade into widespread consumer harm. Effective monitoring requires a sample-based quality assurance program that validates the mathematical output of your automated escrow systems against manual ledger reconciliations. Mortgage servicing also falls heavily under the purview of Regulation X, particularly regarding the handling of error resolution and requests for information. Borrowers possess the right to submit a written request asserting that an error occurred in the servicing of their loan, or simply to request information regarding their account. Upon receipt of such a notice, the servicer must acknowledge the correspondence within 5 business days and perform a reasonable investigation within 30 to 45 days, depending on the specific nature of the inquiry. The compliance professional must ensure that the organization maintains a comprehensive record of all incoming complaints, including detailed timelines and the logic used to reach a resolution. If you overlook these response windows, you risk creating a pattern of non-compliance that will inevitably trigger an enforcement action. The central goal here is consumer harm minimization, which is achieved by demonstrating that the bank can effectively isolate, investigate, and remediate errors before they escalate into systemic failures. The regulatory framework regarding loss mitigation procedures is perhaps the most operationally demanding aspect of modern mortgage servicing. When a borrower expresses a desire for loss mitigation, early intervention requirements mandate that the servicer makes good faith efforts to contact them no later than the 36th day of delinquency. This must be followed by written notices that clearly explain the available loss mitigation options, such as loan modifications or short sales. A critical concept we must grasp is the prohibition against dual tracking, which prevents a servicer from initiating a foreclosure action while a complete loss mitigation application is pending. Compliance with these procedures requires a sophisticated workflow control system that links collection activity with the status of loss mitigation applications in real time. You should prepare to implement rigorous audit testing of these workflows, focusing on whether internal controls prevent the legal team from proceeding with foreclosure when an application is under active review. Effective board reporting metrics should capture these touchpoints, providing oversight committees with the data necessary to evaluate the adequacy of the bank's internal controls. See you in the next lecture. Welcome to our deep dive into the Equal Credit Opportunity Act, commonly known as ECOA or Regulation B. In this chapter, we will explore the core legal requirements designed to ensure all applicants have a fair chance to obtain credit. The foundation of the Equal Credit Opportunity Act centers on the absolute prohibition of credit discrimination based on race, color, religion, national origin, sex, marital status, age, or the receipt of public assistance. When we analyze compliance within this framework, we must look beyond intentional acts of disparate treatment where a lender explicitly treats an applicant differently based on a prohibited characteristic. Often, the more subtle and pernicious risk lies in disparate impact, where a neutral policy disproportionately excludes a protected class. This could manifest in redlining practices, where geographic boundaries are used to deny services to specific communities under the guise of underwriting criteria. As risk professionals, we must scrutinize our models to ensure that parameters are purely merit-based and do not serve as proxies for biased outcomes. If your automated underwriting system relies on variables that correlate too closely with protected statuses, you are likely failing the regulatory test, regardless of manual intent. Managing adverse action notices is perhaps the most frequent point of mechanical failure in many institutions. Regulation B mandates that a creditor notify an applicant of the action taken within 30 days of receiving a completed application. The notice must contain specific details, including the exact reasons for the denial or the applicant's right to request a statement of those reasons. Generic, catch-all denials are insufficient because the agency wants the applicant to understand precisely which credit factors lead to the decision. Beyond the initial notification, we have strict rules regarding spousal signatures and the joint intent documentation. You cannot automatically require a spouse's signature unless the applicant's individual creditworthiness is insufficient, or they are relying on joint assets. Proving this requires a documented, contemporaneous record of the applicant's intent to apply for joint credit, which often requires a specific checkbox captured during the intake workflow. The interaction between ECOA and the Home Mortgage Disclosure Act creates a complex reporting environment that requires precise data handling. When you collect demographic information such as race, ethnicity, and gender, you must clearly distinguish between mandatory government monitoring information and discretionary collection. This data is vital for peer bank benchmarking and identifying potential patterns of unfair lending, but it must be kept separate from the actual credit decisioning process to avoid unconscious bias. In the realm of appraisals, the rules are equally crisp. The law requires providing a copy of the appraisal or other written valuation to the applicant promptly upon completion. Self-testing is your best defense here, as it allows your institution to perform proactive statistical validity checks on your own lending book. If you uncover potential harm, your corrective action planning must address the root cause, rather than just patching the immediate symptoms of the failure. Third-party vendor oversight is another area where many compliance programs falter because they assume a delegated function equals a delegated liability. If your institution uses an outside entity for underwriting or lead generation, you remain fully accountable for any disparate impact these third parties introduce into your system. Quality assurance must extend to these external providers, including regular audits of their decisioning logic and sampling of their denial files. Your board reporting metrics should move beyond simple volume counts to look at approval rate variances and denial disparities across protected groups. Effective change management processes must evaluate any modification to your lending software for potential ECOA implications before the switch is flipped. This ensures that a technical update doesn't accidentally introduce prohibited bias into the workflow. Special purpose credit programs offer a legitimate way to expand access to credit for underserved groups, provided they are structured strictly according to Regulation B guidelines. These programs must be explicitly defined and designed to benefit a class of persons who would otherwise be denied credit or receive it on less favorable terms. Failure to adhere to the statutory requirements for such programs can invite enforcement actions, making documentation essential. Additionally, your record retention policies must be robust enough to withstand examination, keeping all application files and related disclosures for the required timeframes. In the event of a complaint, your tracking and resolution system must demonstrate that the institution conducted a thorough inquiry into the merit of the grievance. This is not just about keeping regulators happy, but about building a culture where consumer harm is identified and mitigated before it scales. See you in the next lecture. Welcome to our exploration of the Home Mortgage Disclosure Act, or HMDA, as implemented through Regulation C. In this chapter, we will master the technical landscape of mortgage data collection and disclosure requirements. HMDA serves as the primary mechanism for monitoring mortgage lending patterns to identify potential discriminatory lending and to ensure institutional transparency. Unlike other consumer protection laws that focus primarily on the interaction between a creditor and a single borrower, HMDA is fundamentally a data gathering statute. It requires covered financial institutions to collect and report a granular set of data regarding their mortgage applications and originations. By analyzing this data, regulators and the public can determine if institutions are serving the housing needs of their communities or if they are systematically excluding specific demographics or geographies. Successfully navigating Regulation C requires a rigorous attention to detail, as the reporting requirements are both prescriptive and unforgiving. We will break down precisely who is subject to these rules and how the data must be synthesized for submission. Understanding institutional coverage is the first hurdle in compliance because not every lender is subject to HMDA. A financial institution is generally covered if it has a physical or branch office in a metropolitan statistical area and meets certain asset size and activity-based thresholds. The activity thresholds are particularly vital, as they define the volume of loans that trigger a filing requirement. These thresholds have evolved over time to exclude smaller, lower-volume lenders, allowing them to focus resources on core business operations rather than regulatory reporting. Once an institution crosses the threshold for covered loan activity, it must implement robust systems to capture every data field for every relevant transaction. Missing a single field doesn't just represent a minor clerical error. It signals a breakdown in the institution's internal control environment that examiners will scrutinize. The transactional coverage of HMDA is a source of frequent confusion, as it determines which specific loans must be recorded in the Loan Application Register, commonly referred to as the LAR. We are concerned with closed-end mortgage loans, open-end lines of credit secured by a dwelling, and business purpose loans that meet the definition of a mortgage transaction. When an institution receives a loan application, it must assign a universal loan identifier, a unique string of characters that allows for exact tracking of the application from start to finish. This identifier must be unique to the institution and remain associated with the application through all subsequent stages, including denial, withdrawal, or closing. Recording the action taken, such as whether a loan was originated or denied, requires a clear definition of when an application is considered finalized. This stage of the process necessitates a mature workflow with defined decision points that trigger the data entry process. Beyond the identifiers and action status, Regulation C mandates the capture of highly specific data fields designed to provide a holistic view of the lending environment. We report on the purpose of the loan, the property's location through geocoding to the census tract level, and specific demographic details of the applicant, including race, ethnicity, and sex. Accuracy in geocoding is non-negotiable, as regulators leverage this data to map out lending patterns and evaluate potential fair lending risks against community demographics. The internal procedures for collecting, validating, and reporting this information must be treated as a high-stakes operational exercise. If your institution's internal systems fail to produce valid headers or formatted data files, the submission will be rejected by the regulatory platform, potentially leading to findings of material noncompliance. These data fields are not just bureaucratic requirements, they are the raw material for the public disclosure reports that can impact an institution's reputation. Managing the submission process requires a deep familiarity with the technical specifications provided by the regulatory agencies, including the specific edit checks that govern data integrity. Before submitting the LAR, the data must pass through syntax, validity, and quality edit checks, which identify everything from impossible date formats to conflicting loan characteristics. An institution must have a robust quality assurance program that employs statistical sampling to audit the accuracy of its LAR before the final filing deadline. Relying on third-party vendors for software solutions does not absolve the institution of its duty, as the board must maintain oversight of the vendor's performance and the institution's ultimate liability. Any discrepancy found during these checks must be addressed immediately, often requiring a root cause analysis to determine if the error is localized or systemic. Effective compliance here rests on the ability to detect, investigate, and correct errors before they are finalized in an official submission. We will also examine how to handle partial exemptions and the nuances of record retention, which remain critical for any upcoming examination. Examiners will not only look at your current submission, but will also test your policy documentation and training materials to ensure they are current relative to recent regulatory interpretations. We must also be prepared to discuss how the institution uses its own HMDA data for peer bank benchmarking and risk assessment methodologies. This allows management to understand its lending footprint relative to regional competitors and identify potential weaknesses before they escalate into consumer harm issues. If a breakdown is identified, corrective action plans must be documented with enough detail to satisfy a regulator that effective remediation has occurred. By integrating HMDA into your broader compliance management system, you move from a reactive posture of reporting to a proactive posture of risk mitigation and data-driven strategy. We'll catch you in our next session. Hello there, and welcome back to the course. In this lesson, we will begin our exploration of the Community Reinvestment Act, focusing on how institutions must demonstrate their commitment to meeting the credit needs of their entire communities. The Community Reinvestment Act is fundamentally built on the expectation that regulated financial institutions serve the convenience and needs of the communities in which they are chartered. When we talk about compliance in this space, we are not just looking at a checklist, but rather at a structural orientation toward lending, investment, and service performance. The core requirement is that an institution must delineate its assessment areas, which are the geographic regions where the bank has its main office, branches, and deposit-taking automated teller machines. These areas must consist of whole geographies, typically counties or census tracts, and they cannot reflect illegal discrimination or arbitrarily exclude low to moderate income areas. Once these areas are defined, the regulator evaluates performance based on specific tests that differ depending on the size and business model of the institution. Understanding these definitions is our first step in moving beyond superficial compliance and into a robust demonstration of institutional accountability. For smaller banks, the examination process is streamlined, focusing primarily on a lending performance evaluation rather than the more complex investment and service tests. However, as an institution crosses specific asset thresholds to become an intermediate or large bank, the regulatory expectations shift toward a more comprehensive quantitative and qualitative analysis. Large banks are subjected to a three-part framework consisting of the lending test, the investment test, and the service test. The lending test evaluates the record of the bank in helping to meet the credit needs of its assessment area through various lending activities, including home mortgage, small business, and community development loans. Simultaneously, the investment test measures the dollar amount of qualified investments that benefit the assessment area or a broader statewide or regional area that includes the assessment area. Finally, the service test considers the extent and innovativeness of the bank's community development services and the accessibility of its delivery systems, such as branch distribution and alternative delivery channels. When we examine the technical nuances of these tests, we must pay close attention to the definition of community development. It is not sufficient to simply perform any charitable act. The activity must have a primary purpose of community development, such as affordable housing, services targeted to low to moderate income individuals, or economic development that supports small businesses. Large banks must document these efforts with precision because examiners will look for statistical evidence and narrative support to justify a rating. This involves maintaining detailed records of qualified investments, which include equity investments, deposits, or grants that promote community welfare. Furthermore, the evaluation of branch distribution requires us to look at the geographic dispersion of offices relative to the low to moderate income tracts within the assessment area. If a bank chooses to close a branch, it must adhere to specific notice requirements, which are often heavily scrutinized because they can signal a reduction in service to the very populations the Act aims to support. Operational excellence in this domain also necessitates that a bank maintains a public file accessible to any interested party upon request. This file must contain the bank's current rating, a list of branches opened or closed, the bank's assessment area map, and a written response from the board of directors or management addressing public comments. Beyond the public file, we must consider the sunshine requirements, which dictate how disclosure must be handled regarding any written agreements between a bank and a non-governmental entity that involves CRA-related services or investments. Managing this relationship requires a workflow that accounts for record retention and ensures that these agreements are publicly available and transparent. Because agencies place such weight on the public nature of these documents, any attempt to obscure them or fail to update them can lead to significant reputational risk and adverse findings during an examination. The goal is to build an audit trail that is not just compliant with the letter of the law, but also defensible during intense regulatory scrutiny. As we deepen our understanding of these requirements, we must also integrate the strategic plan option, which allows a bank to propose a plan for meeting its obligations that departs from the traditional performance tests. This option requires significant negotiation with the regulator and must be developed with substantial public participation. Even if a path is chosen that does not utilize a formal strategic plan, the bank must still employ rigorous internal controls to monitor its lending activities. This includes conducting a periodic self-assessment, which essentially serves as a practice exam. By performing data validation and peer benchmarking, the institution can identify potential gaps in its lending patterns before the actual exam occurs. Such proactive management, coupled with a robust complaint management system that tracks, investigates, and resolves community-related grievances, creates an environment where compliance risk is actively minimized and monitored. See you in the next lecture. Welcome back. In this chapter, we will examine the regulatory requirements imposed by the Flood Disaster Protection Act. We will explore how these rules govern lending within designated hazard areas and define your institutional obligations. The Flood Disaster Protection Act, or FDPA, represents a core component of the regulatory landscape for real estate lending. At its fundamental level, the Act mandates the purchase of flood insurance for loans secured by improved real estate located within a special flood hazard area, commonly known as an SFHA. You must understand that the determination of whether a property falls within this zone is not merely a formality, but a rigorous process requiring the use of a standard flood hazard determination form. The oversight of this process is absolute, meaning that if a bank fails to identify a hazard, the liability remains squarely with the institution. When a property is confirmed to be within an SFHA, the lender must provide specific notice of special flood hazards to the borrower within a reasonable time frame. This notification ensures that the consumer is fully appraised of the risks associated with the property and the subsequent financial implications. Beyond the initial identification, the FDPA introduces the complex dynamics of force placement rules and escrow requirements. If at any point during the life of a loan, the borrower fails to maintain the required flood insurance coverage, the lender is legally obligated to force place the insurance policy. This process requires precise timing and communication to ensure the lender avoids unnecessary risk while remaining compliant with consumer protection standards. Furthermore, regulations now explicitly permit the acceptance of private flood insurance, provided that the policy meets specific criteria equivalent to those mandated by the National Flood Insurance Program. You should also consider the detached structure exemption, which excludes certain non-residential buildings from the mandatory purchase requirement under specific conditions. Managing these exemptions requires granular attention to the specifics of the property in question, as misinterpretation can lead to significant compliance gaps during internal audits. When we look toward the administrative side, we must address maximum coverage limits and the impact of map changes by the Federal Emergency Management Agency. These tripwires often catch institutions off guard, particularly when a map revision places a previously low-risk property into an SFHA, triggering a requirement for new or additional coverage. Effective risk assessment methodologies involve a thorough review of existing portfolios against these updated maps to ensure that no property falls through the cracks. In terms of institutional governance, board reporting metrics should capture the volume and resolution of flood-related compliance exceptions. Documentation must be robust, reflecting not just the existence of a policy, but the operational workflow controls that ensure ongoing adherence to these technical requirements. A well-constructed program relies heavily on accurate threshold computations to determine when insurance coverage is sufficient to meet both regulatory mandates and internal safety requirements. Enforcement actions and the history of agency interpretations provide a roadmap for avoiding common pitfalls in this domain. Statistical validity in your quality assurance sampling is paramount, as auditors will evaluate whether your testing parameters are sufficient to detect systemic failures. We must treat complaint tracking and resolution as a diagnostic tool for identifying root cause issues within the loan origination or servicing process. If the data suggests a recurring failure in monitoring escrow accounts or force placement triggers, your corrective action planning must address the underlying system parameters rather than just the individual loan exceptions. Third-party vendor oversight adds another layer of complexity, particularly when using automated determination services that may suffer from integration failures or outdated data mappings. Integrating these considerations into your change management process ensures that updates to lending software do not inadvertently compromise your flood compliance posture. See you in the next lecture. Welcome to the chapter on the Fair Credit Reporting Act, where we will explore the legal framework governing credit reporting and the responsibilities of financial institutions. We will dive deep into consumer rights, permissible purposes for accessing credit data, and the rigorous obligations placed on data furnishers. The Fair Credit Reporting Act, or FCRA, serves as the cornerstone for maintaining the integrity and accuracy of the consumer credit ecosystem in the United States. At its core, the statute regulates how credit reporting agencies compile, maintain, and share consumer information while providing individuals with tools to dispute inaccuracies. As compliance professionals, our responsibility begins with understanding that a consumer report can only be obtained for a specific permissible purpose defined by the statute. These include, but are not limited to, credit transactions initiated by the consumer, employment purposes, or underwriting insurance policies. Failing to secure a permissible purpose is not merely a procedural error. It is a violation that triggers significant legal exposure and potential statutory damages. You must view the FCRA not just as a set of rules for bureaus, but as a mandate for how your bank interacts with consumer data throughout the entire lifecycle of a lending product. When a financial institution decides to take adverse action against an applicant based on information contained in a consumer report, the duty to disclose becomes absolute. Adverse action notices are intended to provide transparency, ensuring that consumers are informed why their application was denied or why they received less favorable terms than requested. This aligns closely with risk-based pricing rules, where institutions must notify consumers when they offer them credit on terms that are materially less favorable than the most favorable terms available to a substantial proportion of consumers. These notices essentially function as a feedback loop, allowing the consumer to identify potential inaccuracies in their credit file that might be causing their creditworthiness to appear suppressed. Effective compliance programs integrate these notification triggers directly into origination workflows, ensuring the system generates the appropriate disclosure without manual intervention whenever a credit score or report influences a decision. The responsibilities extend significantly to the role of a data furnisher, which encompasses virtually any financial institution that reports account status or payment history to credit bureaus. Furnishers are legally required to provide accurate information and to have internal procedures in place to investigate direct disputes filed by consumers. If a consumer claims information is inaccurate, the bank cannot simply dismiss the claim, but must conduct a reasonable investigation to verify the integrity of the data. Furthermore, the FCRA mandates that institutions have specific procedures for blocking information resulting from identity theft once a consumer provides proof of their status as a victim. This requires a robust synchronization between your frontline operations, your consumer complaint management team, and your IT systems to ensure that identity theft flags are honored promptly. Modern compliance management under the FCRA demands more than just paper policies. It requires quantitative rigor in your oversight processes. You should be benchmarking your bank's performance against industry standards to ensure that your dispute resolution timelines and accuracy metrics remain within acceptable risk tolerances. Statistical sampling is an essential tool here, allowing you to test whether your reporting systems are consistently delivering data that matches your internal records. When you identify root causes for systemic reporting errors, you must move quickly to implement corrective action plans that address the underlying process gaps rather than just patching individual consumer files. Documentation of these internal audits, including the tests performed and the threshold computations for error rates, acts as the primary evidence of your institution's commitment to consumer harm minimization during a regulatory examination. Regarding third-party vendor oversight, you remain responsible for the activities of third parties who report data on your behalf, such as collection agencies or outsourced loan servicing firms. You cannot outsource your compliance obligation, which means you must establish firm contractual requirements and verify the quality assurance of any data submitted by these vendors. A significant part of your risk assessment methodology should focus on the stability of these data pipelines, as a single failure in a batch transmission can result in widespread inaccuracies that harm many consumers simultaneously. Training is the final piece of this puzzle, as your staff must understand not only the technical requirements of the FCRA, but also the ethical implications of how data impacts a person's financial future. Your board of directors should receive regular reporting metrics that clearly illustrate the efficacy of these controls and disclose any significant compliance incidents or regulatory inquiries. See you in the next lecture. Welcome to our exploration of the Fair and Accurate Credit Transactions Act, where we will examine how this legislation enhances consumer protection and data security. We're going to break down the complex requirements regarding information privacy and the specific preventive measures institutions must implement. The Fair and Accurate Credit Transactions Act, often known as FACTA, serves as a crucial amendment to the Fair Credit Reporting Act, primarily designed to bolster the accuracy of consumer credit information and combat identity theft. When we look at the statute from a systems perspective, we see it imposes affirmative duties on financial institutions to handle consumer data with a higher degree of granularity and protection. The legislation introduces the disposal rule, which mandates the secure destruction of consumer report information to prevent unauthorized access. This isn't merely about shredding documents. It involves implementing rigorous policies that ensure data is unreadable and irretrievable once it reaches the end of its business lifecycle. Furthermore, the Act requires businesses to truncate credit and debit card numbers on electronically printed receipts, ensuring that the primary account number is obscured to protect the cardholder. By restricting the information displayed at the point of sale, the law reduces the utility of intercepted receipts for fraudulent purposes, thereby mitigating the risk of downstream identity theft. A significant architectural component of FACTA is the requirement for financial institutions to address discrepancies in consumer addresses. When a consumer reporting agency provides a notice of address discrepancy, the institution must have internal procedures to reconcile the consumer's address with the records obtained during the normal course of business. This is not just a clerical task, it is a verification control designed to prevent identity thieves from hijacking accounts by providing a fraudulent address. Beyond this, institutions must facilitate free credit reports for consumers, empowering individuals to monitor their own data for irregularities that might signal unauthorized activity. Complementing these access rights, the Act mandates the provision of fraud alerts and active duty alerts for military personnel. These alerts proactively flag a consumer's file, notifying potential creditors that they should take extra steps to verify the identity of the person seeking credit. This mechanism acts as a programmatic gatekeeper, ensuring that accounts are not opened under false pretenses while a consumer is deployed or has otherwise flagged their identity as potentially compromised. The regulatory framework further emphasizes the role of affiliate marketing, where FACTA imposes specific notice and opt-out requirements if an institution intends to use consumer information shared by an affiliate to make marketing solicitations. From a compliance engineering perspective, this requires a robust data lineage and mapping system to ensure that information shared within corporate structures is correctly identified and filtered according to consumer preferences. If we fail to manage these opt-outs correctly, we inadvertently violate privacy statutes that carry significant legislative penalties. Risk assessment methodologies in this domain must therefore account for the flow of data between parent companies and subsidiaries, ensuring that the consumer's choice is respected across all communication channels. The underlying logic is simple. The consumer owns their data and the relationship they have with the bank, not the corporate entity structure that underpins the organization. Consequently, your compliance program must treat the opt-out mechanism as a hard constraint in your marketing data workflow. Managing compliance under these rules requires more than just a policy manual. It necessitates active monitoring and periodic audit testing to ensure that procedural controls remain effective. We need to implement statistical sampling of our disposal processes to confirm that we are meeting the destruction standards set by external regulators. Additionally, board reporting metrics should capture the efficacy of our identity theft prevention programs, focusing on the volume and resolution of address discrepancy notices. When we evaluate third-party vendor oversight, we have to look for gaps where service providers might be handling consumer data without adhering to the same truncation or disposal standards applied internally. This is where quality assurance comes into play, as we must verify that our third-party relationships do not introduce vulnerabilities into our broader risk surface. Change management processes should also be updated to ensure that any modification to our IT systems or record retention rules does not inadvertently bypass these statutory protections. Effective compliance is ultimately about minimizing consumer harm through structured, traceable actions. We must maintain clear audit trails of our complaint tracking and the resolution timeframes for suspected identity theft incidents to demonstrate responsiveness to regulatory examiners. Root cause analysis is essential when we encounter lapses, as it allows us to refine our corrective action planning and prevent recurrence. By benchmarking our performance against industry peers, we can gain insights into whether our internal systems are achieving the intended outcomes or if our controls are becoming stale and overly bureaucratic. Ultimately, the goal is to create a seamless security posture that protects consumer identity as a default state, leaving no room for human error in the application of these fundamental consumer rights. We are not just checking boxes. We are designing systems that sustain trust between the bank and the customer, which is the cornerstone of the entire banking system. See you in the next lecture. Welcome to the chapter on the Servicemembers Civil Relief Act, where we will examine the statutory protections afforded to military personnel and how institutions must adapt their internal controls to maintain compliance. We will build a technical understanding of the regulatory requirements that govern interest rate limitations, foreclosure protections, and the mechanics of verification. The Servicemembers Civil Relief Act provides financial and legal protections to individuals in military service, intending to alleviate the stress of transitioning to active duty. When evaluating compliance under this framework, the most prominent provision is the 6% interest rate cap. This cap applies to obligations incurred prior to the commencement of active duty and extends to any fees that would otherwise push the effective interest rate above the statutory threshold. It is essential to recognize that this is a retroactive application. Once a member provides their military orders and a written request, the institution must forgive interest in excess of 6% dating back to the start of their active duty period. Furthermore, this limitation mandates that the excess interest must be permanently forgiven rather than merely deferred or capitalized into the principal balance. Banks often struggle with this distinction, as failing to properly adjust the billing system logic can lead to ongoing systemic errors and eventual findings during an examination. Documentation and verification play a pivotal role in the operational lifecycle of SCRA compliance. Institutions are expected to perform rigorous checks using the Department of Defense Manpower Data Center, or DMDC, to verify the active duty status of customers. While the database is a primary tool, it is not an exhaustive substitute for proactive communication and the acceptance of legal documents such as military orders. Reliance on the DMDC alone can be risky if there are delays in data synchronization or if the soldier's status is not yet reflected in the system. Beyond verification, the institution's internal workflow must account for protections against default judgments, evictions, and auto repossessions. Before taking any enforcement action against a customer, a bank must determine if the individual qualifies for SCRA protections to avoid the severe consequences of violating these specialized civil procedures. Navigating the nuances of lease terminations and interest rate calculations requires a granular approach to policy documentation and internal quality assurance. For instance, in the context of lease terminations for housing or automobiles, the bank must have clear procedures for assessing the validity of termination notices and ensuring the effective date is honored without penalizing the service member. Risk assessment methodologies should incorporate the specific dangers of non-compliance here, such as the potential for class action litigation or regulatory enforcement actions stemming from harm to protected classes. Board reporting metrics must track the volume of requests, the speed of resolution, and the results of periodic audits to ensure that the controls are functioning as intended. If a bank relies on third-party vendors for loan servicing or debt collection, the oversight program must extend to those parties to ensure they are also adhering to SCRA requirements on behalf of the financial institution. Effective compliance management for the SCRA goes beyond just checking the boxes. It necessitates a feedback loop that utilizes root cause analysis when errors are identified. Suppose an audit reveals a failure to apply the interest rate cap to a subset of accounts originated before deployment. Instead of simply processing the refund, A compliance officer should investigate whether the issue originated from a change in the core banking system or a gap in the frontline staff's understanding of the submission requirements. This moves the organization from a reactive posture to a proactive one, where change management processes assess new products for SCRA impact before they are even launched. Statistical validity and quality assurance sampling helps ensure that these controls are not just theoretical, but consistently applied across the broad portfolio. By maintaining systemic guardrails, such as blocks on foreclosure proceedings for verified active duty service members, the bank minimizes the risk of inadvertently violating the law and demonstrates a robust commitment to consumer harm minimization. I look forward to discussing the next topic together. Welcome back. In this chapter, we will explore the nuances of the Military Lending Act to ensure your institutional practices remain strictly compliant with federal consumer protection requirements. The Military Lending Act, or MLA, is designed to protect active duty service members and their dependents from predatory lending practices. Unlike many other consumer protection laws, the MLA imposes a strict cap on the military annual percentage rate, or MAPR, set at 36%. Understanding how to calculate this rate is fundamental, as it includes more than just the standard interest rate. You must include all finance charges, credit insurance premiums, fees for ancillary products sold in connection with the credit, and certain participation fees. If your calculation fails to aggregate these components accurately, you risk inadvertent violations that can lead to significant regulatory scrutiny for your institution. When identifying a covered borrower, the reliance on the Department of Defense's MLA database is your primary safe harbor. You should perform these checks before the consummation of a loan, or when a consumer opens an account, ensuring your records verify the status of the service member or dependent effectively. It is not enough to rely on self-disclosure. You need robust system parameters that integrate this database check into your loan origination workflow. Furthermore, you must provide mandatory oral disclosures alongside your written agreements, ensuring the service member understands their rights and the specific terms of the credit transaction. Failure to document both the delivery of these disclosures and the specific timing of the check can create gaps in your audit trail that examiners will easily spot. The law is uncompromising when it comes to specific loan features that target vulnerable populations through debt traps. You are prohibited from requiring a military borrower to submit to mandatory arbitration as a condition of receiving credit. Additionally, the Act places limitations on the use of allotments and payroll deductions, specifically designed to prevent lenders from securing guaranteed repayment through the service member's paycheck in ways that could undermine their financial stability. Vehicle title loans are another high-risk area where the MLA imposes strict prohibitions, preventing lenders from holding a vehicle title as security for a loan to a covered borrower. Your existing lending policies must explicitly address these prohibitions, and your internal control should prevent system-level acceptance of loan applications that include these restricted features. Beyond the technical requirements of the product, your institution needs a comprehensive internal framework to manage MLA compliance. This begins with rigorous risk assessment methodologies that identify where your bank might be susceptible to violations, particularly in how you define and calculate the MAPR. Your training programs must be tailored to ensure that loan officers understand why certain fees are included in the MAPR calculation and why others are excluded. Board reporting metrics should track the frequency of covered borrower identification and any instances where loans were rejected based on these protected categories. By establishing these documentation standards well in advance, you minimize the risk that a regulatory enforcement action will find your institution lacking in oversight. Effective quality assurance requires you to implement statistical validity when sampling your loan portfolios for MLA compliance. You should conduct periodic testing to verify that third-party vendors, particularly those involved in secondary underwriting or credit insurance sales, are adhering to the same standards as your internal staff. Managing complaints from active duty members requires specialized tracking, as these files often carry higher reputational risk and invite closer inspection from regulators. When you identify a root cause of a potential non-compliance issue, you must implement corrective action plans immediately, rather than waiting for an annual audit. Consistent monitoring of these workflows serves as your best defense against consumer harm and keeps your institution aligned with the ongoing enforcement priorities of the Consumer Financial Protection Bureau and the Department of Defense. I will see you in the next lecture. Welcome back. In this chapter, we will master the Fair Housing Act, a pillar of federal fair lending regulation that safeguards equal access to housing. The Fair Housing Act, or FHA, serves as the fundamental legislative framework prohibiting discrimination in the sale, rental, and financing of dwellings. As a compliance professional, understanding this landscape requires looking beyond mere intent, as the regulation reaches into the core of how institutions structure their residential real estate lending. We are specifically concerned with the prohibited bases, which include race, color, national origin, religion, sex, familial status, and disability. Unlike other consumer protection laws that might focus strictly on creditworthiness, the FHA creates a broad net covering any transaction connected to housing. This encompasses not just the act of granting an extension of credit, but also the valuation of property through appraisals and the marketing of those credit products. One of the most persistent challenges in managing FHA risk is the concept of disparate impact. This legal theory posits that a policy or practice may be neutral on its face, but still violate the statute if it disproportionately affects a protected group without a legitimate business necessity. When we assess institutional risk, we aren't just looking for explicit acts of discrimination like individual bias, but rather for algorithmic or systemic tendencies that might inadvertently exclude protected classes. Steering, where an applicant is directed toward or away from specific neighborhoods or loan products based on their protected status, remains a high-risk area that examiners monitor closely. Similarly, practices known historically as blockbusting or modern variations of digital redlining require rigorous audit testing parameters to ensure that every aspect of the marketing workflow aligns with fair housing principles. Operational compliance under the FHA necessitates robust control environments, starting with clear policy documentation that filters down to frontline employee training. You must implement specific physical and digital identifiers, such as the equal housing lender logotype and the required poster, which must be prominently displayed to signal your institution's commitment to non-discrimination. Accessibility requirements for multifamily dwellings are a technical component that often gets overlooked in broad compliance programs. Yet they form a critical part of the regulatory expectation. When an institution acts as a creditor in a housing transaction, the oversight extends to every third-party vendor that might influence the application process. This means your quality assurance team must perform periodic sampling of files to ensure that appraisal practices do not exhibit bias and that the overall decision-making workflow remains free from discriminatory patterns. The enforcement landscape is shaped heavily by HUD guidance and the examination manual procedures that dictate how regulators assess your individual internal systems. A strong compliance management system incorporates a sophisticated complaint tracking mechanism capable of root cause analysis to identify potential violations before they escalate into government enforcement actions. We must focus on the granularity of our data, ensuring that threshold computations, such as those used in benchmarking peer banks, are statistically valid and consistently applied. If a review suggests that a practice may lead to consumer harm, the proactive corrective action planning process must be initiated immediately to mitigate liability. This is not static work. It requires continuous monitoring of system parameters and a disciplined approach to change management whenever credit products or underwriting guidelines are updated. Record retention rules under the FHA are stringent, as regulators rely on the completeness of your data to perform their own independent statistical analyses during an examination. You must be able to justify the rationale behind every denied loan, demonstrating that the decision was based on objective, non-discriminatory criteria rather than prohibited factors. Board reporting metrics serve as the final lens through which executive leadership understands the institution's exposure, making it imperative that the data presented is both accurate and reflective of the actual risk profile. By integrating these systems, from initial advertising requirements to final loan disposition and complaint resolution, you create a defensive perimeter that protects the institution from both the legal and reputational costs of a fair housing failure. These controls are not just for show. They represent the operational reality of maintaining a compliant, fair, and inclusive lending environment. See you in the next lecture. Welcome back. In this chapter, we explore the Homeowners Protection Act and how it governs the cancellation and termination of private mortgage insurance. The Homeowners Protection Act, commonly referred to as HPA, serves as a federal mandate to protect homeowners by regulating when private mortgage insurance, or PMI, must be removed from their loans. As a compliance professional, you need to understand that this is not merely a suggestion, but a strict requirement that dictates when lenders must stop collecting these premiums. When you master these rules, you minimize the risk of consumer harm and ensure your institution avoids the regulatory scrutiny that follows systemic errors in termination processes. Throughout this chapter, we will dissect the mechanical requirements of the Act, starting from the inception of the loan and moving through to the final disclosure mandates. You will learn the exact sequence of events required for both borrower-requested cancellation and automatic termination of coverage. By the time we conclude our review, you will possess the ability to structure audit testing parameters that effectively detect compliance failures in your internal workflows. This knowledge is essential for passing the CRCM exam and for maintaining a robust regulatory compliance management system within your bank. The core of the Act focuses on the distinction between borrower-requested cancellation and automatic termination, which are based on different loan-to-value calculations. For borrower-requested cancellation, the law permits the borrower to initiate the process once the principal balance reaches 80% of the original value of the property. However, this is not an automatic right unless the borrower has a good payment history and meets specific criteria regarding the property status. If the borrower is current and can provide evidence that the value of the property has not declined below its original appraisal, the lender is effectively obligated to cancel the insurance. Situations involving high-risk loans naturally fall outside standard cancellation timelines, adding a layer of complexity to your risk assessment methodologies. You must also account for how loan modifications might trigger resets in the borrower's ability to request cancellation or alter the schedule for automatic terminations. It is therefore critical to maintain precise documentation that tracks the original value versus the current value to ensure these triggers are correctly identified. Automatic termination serves as the final safety net for the borrower, mandated by the statute when the principal balance reaches 78% of the original value of the property. This happens regardless of the borrower's request, provided the mortgage is current at that specific point in time. If the borrower is not current, the termination occurs on the first day of the following month after the balance drops to that 78% threshold, assuming the default has been cured. One of the most often overlooked aspects of the Act involves the return of unearned premiums, which lenders must process within 30 days of the cancellation or termination date. From an operational perspective, your system parameters must be configured to calculate these thresholds accurately and trigger notices without manual intervention. If your bank relies on third-party vendors for loan servicing, your oversight must extend to their quality assurance processes to verify that they are not retaining premiums they are legally required to refund. Auditing these workflows requires statistical validity in your sampling methods to ensure that across your entire mortgage portfolio, no consumer is overpaying for insurance coverage. Managing compliance under this Act requires a synthesis of policy, system configuration, and continuous monitoring to ensure that no exceptions go unnoticed. You should pay close attention to the timing requirements for initial disclosures provided at the time of loan consummation, as these set the tone for the entire customer lifecycle. If an adjustable rate mortgage or a fixed rate mortgage is serviced by your institution, the system must distinguish between the specific requirements for each, as they can sometimes lead to different treatment regarding termination dates. Board reporting metrics should ideally highlight the percentage of mortgages that reach PMI termination thresholds and track how effectively your bank meets its administrative obligations. When errors occur, your root cause analysis must look beyond the immediate fix and evaluate if the failure was a result of a flawed change management process or a lack of employee training. Finally, consistent peer bank benchmarking can help you identify if your internal controls are keeping pace with industry expectations and regulatory enforcement precedents. By integrating these compliance elements into your existing risk framework, you transform an operational requirement into a repeatable and auditable business process. See you in the next lecture. Welcome to our deep dive into the Electronic Fund Transfer Act and its implementing Regulation E. In this chapter, we will explore the legal framework governing electronic payment systems and protect the consumer interests at their heart. The Electronic Fund Transfer Act provides a comprehensive framework for the rights, liabilities, and responsibilities of participants in electronic fund transfer systems. Regulation E is the primary vehicle by which the Consumer Financial Protection Bureau enforces these statutes, focusing heavily on consumer protection in the face of unauthorized transactions. When you are operating in this space, you must recognize that the statute defines an electronic fund transfer as any transfer of funds initiated through an electronic terminal, telephone, computer, or magnetic tape. This includes debit card transactions, automated clearinghouse credits or debits, and ATM transactions. The core objective here is to shift the burden of system failure and unauthorized activity away from the individual consumer. By design, Regulation E places strict limits on consumer liability, provided the consumer reports the unauthorized transaction within defined timeframes. Understanding these notification windows is not merely a rote memorization task, but a fundamental requirement for assessing bank liability during internal audits. Error resolution is arguably the most critical operational component of Regulation E adherence. When a consumer notifies your institution of an error, you must follow a rigid procedural timeline to investigate and resolve the dispute. This process necessitates a thorough investigation, which must generally be completed within 10 business days. If you find that more time is required to conclude your inquiry, you are permitted to extend the investigation period up to 45 days, provided you issue a provisional credit to the consumer's account for the amount in dispute. This concept of provisional credit is a cornerstone of the regulation, ensuring that the consumer is not deprived of their funds while the institution untangles the complexity of a transaction. Your record retention systems must be capable of tracking these timelines with precision, as regulators will look for evidence of timely notices to consumers regarding the status of their investigations. Any failure to meet these thresholds exposes the bank to civil liability and reputational damage. The landscape of Regulation E has expanded significantly to address the proliferation of prepaid accounts and remittance transfers. Prepaid accounts are now subject to the same oversight as traditional debit cards, requiring you to provide clear disclosures regarding fees, balance inquiries, and transaction histories before a consumer obtains the card. Furthermore, the regulation imposes strict requirements on remittance transfers, ensuring that consumers who send money internationally receive information about exchange rates, transfer fees, and expected delivery dates before the transaction is finalized. These disclosures must be transparent and, in some cases, provided in a language other than English if the institution advertises in that language. You must also implement mechanisms that allow consumers to cancel these transfers within a specific window, provided the funds have not already been delivered. These specific operational controls should be integrated into your core processing systems to ensure that consumer rights are protected at every stage of the transaction lifecycle. Beyond the basic transactional rules, institutions must manage the technical aspects of overdraft protection and card issuance. Under Regulation E, you are prohibited from assessing overdraft fees for ATM or one-time debit card transactions unless the consumer has explicitly opted in to your overdraft service. This opt-in requirement is a strict regulatory threshold that necessitates documented evidence of the consumer's affirmative consent. When designing your compliance management system, you should treat your overdraft disclosures as high-risk documentation that requires regular testing for accuracy and clarity. Additionally, there are specific constraints on the unsolicited issuance of debit cards, which must only be issued in response to a consumer request or as a renewal or substitute for an accepted access device. Managing these rules requires robust workflow controls that prevent unauthorized card distribution while ensuring seamless service to existing customers. Effective compliance with Regulation E is ultimately a matter of rigorous risk assessment and operational oversight. You need to establish audit testing parameters that evaluate the statistical validity of your error resolution performance, ensuring that your sampling methods provide an accurate representation of your actual bank practices. This involves not only automated system checks, but also a culture of quality assurance that periodically reviews the work of frontline staff who handle consumer inquiries. Your board of directors and senior management team should receive regular reports detailing the volume of disputes, the average resolution times per category, and any identified root causes of recurring errors. By tracking these metrics, you can identify systemic issues, such as poor vendor performance or flawed system programming, before they manifest as significant consumer harm or enforcement actions. A proactive approach to change management, where regulatory updates are seamlessly integrated into your internal policies and training programs, will minimize your risk and help you maintain a state of continuous compliance. I will see you in the next lecture. Hello. Let us look at the mechanics of bank reserve requirements and how they shape our operational landscape. Regulation D defines the framework under which depository institutions manage their reserve accounts, a topic often misunderstood due to shifting monetary policy goals. At its core, the regulation distinguishes between various classes of deposits, primarily transaction accounts, savings deposits, and time deposits. Transaction accounts are those where the depositor is permitted to make transfers or withdrawals by negotiable or transferable instrument, payment order, or telephone or other electronic means for the purpose of making payments to third parties. Savings deposits include accounts where the depositor is permitted to make transfers, but they historically carried limitations on the number of convenient transfers allowed. It is essential to recognize that the legal definition of these accounts determines the applicable reserve requirement ratios, though the practical landscape has changed significantly in recent years. Specifically, the removal of the 6 transfer limit on savings deposits fundamentally altered how institutions classify accounts for reporting purposes. When we discuss reserve calculation methodologies, we are looking at the average balance of these accounts over a maintenance period. Reporting accuracy here is not merely an administrative checkbox. It is a fundamental requirement for the Federal Reserve to gauge the liquidity circulating within the system. The shift toward an interest on reserve balances framework has moved the focus away from the binding nature of reserve requirements toward the use of interest rates as a tool for monetary policy implementation. Historically, banks held reserves as a fractional requirement to prevent liquidity crises, but today, these balances serve primarily as a mechanism for the Federal Reserve to establish a floor for overnight interest rates. Even with requirements currently set at 0%, the underlying definitions remain critical because they govern how internal systems classify deposit products. If your institution uses sweep programs to shift funds between transaction and non-transaction accounts, those automated processes must be built upon sound data definitions. A sweep account effectively moves a portion of a customer's balance into a different legal category to optimize the bank's balance sheet position. If these classifications are incorrect at the source, your reporting to the central bank becomes polluted with noise that suggests systemic patterns that do not actually exist. Proper risk assessment necessitates that we understand not just the current regulatory stance, but the inherent structural risks involved if these systemic levels were ever adjusted again. When we examine the broader control environment, we must address the infrastructure supporting these regulatory reports, starting with data aggregation and quality assurance. Your bank's internal controls must ensure that the software parameters properly flag account types according to their legal status rather than just their marketing labels. This involves a rigorous workflow where changes to product features undergo a formal change management review before deployment. If a product development team adds a feature that allows unlimited third-party payments to a savings account, that change might inadvertently transform the account into a transaction account. Failing to update the system parameters at that moment results in incorrect reporting, which, while perhaps not carrying a heavy fine at a 0% reserve environment, creates a failure in your compliance management system. You need to implement testing parameters that sample account activity regularly to ensure that the actual usage behavior matches the product classification. This is where audit testing intersects with operational efficiency, as you seek to minimize consumer harm and ensure that disclosures align with the underlying legal status of the funds. Third-party vendor oversight plays an equally critical role when you utilize outside core banking platforms for this data management. You are responsible for the compliance of the regulatory outputs generated by these systems, regardless of whether a vendor maintains the underlying code. Your vendor management program should include specific oversight of the logic used in reserve reporting, including periodic independent validation of the definitions applied. Furthermore, your board reporting metrics should provide a clear view of how these balances are evolving, especially if the bank is experiencing rapid shifts in deposit composition. If you notice a high volume of exceptions in your sampling, this is often a signal to investigate the root cause, which may lie in how frontline staff initiate new account setups. A robust corrective action plan should follow any identified discrepancy, ensuring that the logic is repaired and the data integrity is restored. When you layer in the potential for enforcement action precedent, you see why documenting your methodology and your rationale for account classification is your primary defense during an exam. These records demonstrate to regulators that you have exercised appropriate due diligence in maintaining the integrity of your reported data. Good luck with your review. Welcome back. We are now moving into the domain of Regulation CC, which implements the Expedited Funds Availability Act to govern the timing of fund availability for customers. The primary objective of the Expedited Funds Availability Act, and consequently Regulation CC, is to standardize the schedules by which financial institutions must make deposited funds available to customers. When a customer deposits a check, the funds represent a promise of payment that must be cleared through the collection system. Statutory schedules dictate when that promise becomes usable cash, balancing the bank's need to verify the source of funds against the customer's need for liquidity. These requirements do not apply to cash deposits or electronic payments, which have their own specific handling protocols under other regulatory frameworks. Instead, the focus remains squarely on the processing of paper checks and the operational realities of the clearinghouse infrastructure. When navigating these requirements, you must understand the distinction between next-day items, local checks, and the defunct category of non-local items, as the latter was effectively collapsed into a single standard following the implementation of Check 21. Adherence to these timeframes is not merely an operational goal, but a strict regulatory mandate that, if breached, subjects the institution to potential civil liability and supervisory scrutiny. Check 21, the Check Clearing for the 21st Century Act, fundamentally altered the landscape by introducing the substitute check. This allows banks to process checks electronically by creating a paper reproduction that is legally equivalent to the original document. When a bank provides a substitute check, it must provide specific warranties and indemnities to the recipient, ensuring that the party receiving the image or the substitute does not suffer a loss due to the lack of an original physical instrument. As a compliance manager, your role is to ensure that your bank's internal processing systems correctly handle these substitutes and that your disclosures clearly reflect the rights of consumers regarding the receipt of such documents. Mismanaging these indemnities can create significant legal exposure if an error occurs during the document truncation process. Furthermore, the routing numbers and the proper placement of endorsements are critical components in ensuring that these substitute checks flow correctly through the clearing system. Failure to adhere to these technical standards can cause delays, manual reconciliation burdens, and potential violations of the availability schedules. Beyond the standard schedules, Regulation CC provides specific authority for banks to impose exception holds, provided they meet strict documentation and notification requirements. You might apply an exception hold for large deposits, defined as those exceeding $5,000, or when you have reasonable cause to believe that a check is uncollectible. Other common triggers include redeposited checks, which have already been returned unpaid, or accounts that exhibit a pattern of repeated overdrafts, indicating a higher risk profile. A new account status also permits longer hold periods, as the bank has not yet established a sufficient history to assess the customer's reliability. These holds must be applied in a non-discriminatory manner, and the customer must receive a timely notice explaining why their funds are being restricted and when they will eventually become available. The integrity of your hold process depends on your ability to substantiate the reasonable cause with concrete data rather than conjecture. Inconsistent application of these exceptions is a frequent point of failure during regulatory examinations and can easily lead to findings of unfair or deceptive practices. Effective compliance with these rules requires a robust framework that integrates policy documentation with automated system parameters. You must design workflows that ensure the core banking system automatically calculates hold periods based on the type of deposit and the specific account attributes. Periodic review of these system parameters is essential to identify drift where manual overrides or automated errors might cause systemic noncompliance. Your internal audit function should focus on performing statistical sampling of deposit batches to verify that the hold durations applied align with the regulatory mandates and the bank's internal policy. Furthermore, complaint tracking serves as a vital diagnostic tool, as customers who are improperly deprived of their funds are often the first to surface issues. When a complaint arises, your resolution process must involve a root cause analysis to determine whether the problem originated in human error, software limitations, or a misunderstanding of the threshold computations. By tracking these metrics, you generate board-level reports that demonstrate your proactive management of the deposit operation risk landscape. Third-party vendor oversight is perhaps the most overlooked area when discussing check processing and expedite availability. Many banks outsource their check imaging and clearing services to regional processors or other larger financial institutions. If your vendor fails to comply with the timing requirements for processing a check, or if they generate incorrect substitute checks, the liability usually remains with your institution from the customer's perspective. You must ensure that your service level agreements include explicit clauses regarding the vendor's responsibilities for timely data transmission and adherence to the warranties required by law. Quality assurance exercises should extend to these vendors, requiring them to provide their own internal audit results or bridge letters regarding their compliance posture. If you find a breakdown in the vendor's workflow, you must initiate a corrective action plan immediately, as gaps in vendor performance directly translate into risks of consumer harm and regulatory enforcement actions. Your duty is to bridge the gap between the bank's policy and the reality of the external clearinghouses. Compliance ultimately hinges on your ability to translate these regulatory requirements into documented processes that are both defensible and replicable. When regulators arrive for an examination, they will look for evidence of your annual review of the check processing workflow against current agency interpretations. They expect to see clear metrics regarding the volume of exception holds, the typical hold durations, and most importantly, the rate of errors identified through your own internal monitoring. Keeping comprehensive records of these activities is not just an administrative burden, but a prerequisite for avoiding penalties. If an enforcement action is initiated due to systemic failures, the presence of these records can prove that the organization operated in good faith and had adequate controls in place. Remember that the goal of this compliance management system is to provide a safety net that protects the consumer's financial liquidity while maintaining a secure and efficient check clearing process. Consistent monitoring and iterative improvement are the only ways to stay ahead of the evolving threats in this operational space. See you in the next lecture. Welcome to our discussion on truth in savings, a critical component of retail banking compliance that directly impacts how institutions communicate with their depositors. In this chapter, we will master the intricacies of Regulation DD to ensure your bank remains both compliant and competitive. The Truth in Savings Act, implemented through Regulation DD, serves as the cornerstone for consumer transparency regarding deposit accounts. Its primary objective is to require institutions to provide clear and uniform disclosures, enabling customers to make informed comparisons between different financial products. When we examine the annual percentage yield, or APY, we are essentially looking at a standardized metric that reflects the total amount of interest a depositor receives on an account based on the interest rate and the frequency of compounding. By mandating this calculation, regulators prevent banks from using deceptive marketing tactics that might inflate perceived returns. You must understand that the APY calculation is not merely a suggestion. It is a rigid mathematical requirement that accounts for the effects of compounding over a 365-day period, regardless of whether the bank uses a 360-day or 365-day basis for actual interest accrual. This alignment of disclosures ensures that a consumer looking at two different rate sheets can mathematically equate the value of their holdings across institutions. Beyond the initial disclosure requirements, Regulation DD imposes strict rules on how interest is calculated on balances. The two primary methods you will encounter are the daily balance method and the average daily balance method, and the distinction between them is significant for your risk management systems. The daily balance method applies a daily periodic rate to the full principal balance in the account each day, whereas the average daily balance method sums the balances for each day in the period and divides by the total number of days. If your bank's system parameters are misconfigured, you risk failing your internal audit test regarding interest payout accuracy. Furthermore, these balance calculations must be supported by transparent advertising practices. When you advertise a specific account, the inclusion of trigger terms, like stating an interest rate or a bonus, obligates you to include specific disclaimers immediately. Failing to disclose the APY, the period during which the offer is in effect, and any minimum balance requirements alongside these triggers is a common compliance deficiency found during regulatory examinations. Operational compliance also requires careful attention to the life cycle of an account, particularly regarding grace periods and change in terms notices. If a bank maintains a grace period after maturity, it must be clearly disclosed so the depositor understands they will not lose interest if they withdraw funds immediately upon the account's renewal date. When a bank decides to alter a term that was disclosed at account opening, Regulation DD mandates that notice be provided at least 30 calendar days before the change takes effect, provided that the change adversely affects the consumer. This notification requirement acts as a safeguard against unilateral bank actions that could surprise a depositor. Regarding maturity notices for time deposits, the timing depends on the term of the account. For instance, longer-term accounts require more lead time to allow the customer to decide whether to roll over the funds or withdraw them. Managing these workflows accurately preserves the integrity of the institution and prevents potential claims of unfair, deceptive, or abusive acts. The examination process for truth in savings focuses heavily on the consistency between your bank's policy documentation and its operational reality. Examiners will look at your statistical validity and quality assurance sampling to verify that the APY presented to the customer consistently matches the interest paid through your core banking system. Your risk assessment methodologies should specifically address the potential for consumer harm arising from inaccurate overdraft fee disclosures or improper maturity notices. If your system parameters do not align with the regulatory definitions of those terms, you invite enforcement actions that can lead to significant reputational and financial damage. Furthermore, strong complaint tracking resolution timeframes are necessary to demonstrate that your bank can address consumer confusion regarding interest accrual internally. Robust board reporting metrics provide your leadership team with the visibility required to oversee these complex workflows, ensuring that any identified root cause for a compliance gap is addressed through effective corrective action planning. See you in the next lecture. Welcome to this deep dive into the Electronic Signatures in Global and National Commerce Act. In this chapter, we will master the legal framework that enables digital contracts and the specific compliance requirements for consumer disclosures. The e-Sign Act functions as the cornerstone of modern electronic commerce, establishing that contracts or signatures cannot be denied legal effect solely because they are in electronic form. From a compliance perspective, the statute is intentionally technology neutral, meaning the law does not mandate specific software or hardware configurations for the implementation of digital agreements. However, the true complexity arises when we look at the interaction between e-sign and consumer safety regulations. Before a financial institution can provide legally binding electronic disclosures, they must obtain affirmative consent from the customer. This consent process is not a mere checkbox at the bottom of a web page, but a deliberate protocol that demonstrates the consumer's ability to access and retain the information in the format used for the transaction. If your electronic disclosure system fails to be compatible with the browser configuration of a typical applicant, that consent is effectively void under federal standards. The burden of demonstrating this ability sits squarely on the bank, requiring a reasonable demonstration of technical capacity. This is often accomplished through a self-test, where the user must open a document or confirm a specific digital prompt before the bank proceeds with electronic delivery. Crucially, the consumer retains the right to withdraw this consent at any time, and your workflows must be robust enough to immediately transition that customer back to a paper-based record-keeping process. This creates a significant operational challenge in third-party vendor oversight, as many banks outsource the hosting of click-to-accept interfaces. You must ensure that the vendor system preserves the integrity of the audit trail, documenting exactly what the consumer saw, the version of the disclosures provided, and the precise moment consent was timestamped. If a regulator conducts an exam and identifies a gap in your record retention, the lack of a clear electronic audit trail makes it nearly impossible to prove the validity of the underlying contract. Beyond the technical hurdles, we must address the management of cross-border implications and the harmonization of your internal documentation with broader agency interpretations. While e-Sign provides the authority for electronic signatures, its application is restricted by the necessity to maintain record accessibility throughout the lifecycle of the loan or deposit. This implies that your IT system parameters must guarantee that an electronic record remains legible and unalterable for as long as a record retention schedule prescribes. We evaluate this through rigorous internal audit testing, utilizing statistical sampling of electronic files to verify that each digital folder contains all required signatures and disclosures. If you are scaling your digital onboarding, your compliance team should already have implemented specific threshold computations to flag errors in the signature verification process. Any systemic failure here acts as a catalyst for consumer harm, which examiners prioritize during site visits and complaint tracking reviews. Comprehensive compliance framework must also look toward root cause analysis when electronic record discrepancies occur. Suppose your monitoring system flags a high frequency of signature mismatch errors in an online loan application portal. Simply retraining staff is insufficient if the root cause is a faulty interface logic update. You must document the corrective action planning, verify the fix with updated system parameters, and monitor for a decrease in error rates over the following quarters. We also look at peer bank benchmarking to understand how common regional deviations are being handled without relying on their practices as a safe harbor for our own oversight. If your board reporting metrics do not explicitly include the status of electronic record integrity, you are missing a critical pillar of operational risk management. Remember that the regulator is not looking for a perfect system, but rather a transparent, well-documented process that minimizes the chance of an unenforceable contract while preserving customer privacy. See you in the next lecture. Welcome back to the course, where we turn our focus to the complex landscape of overdraft protection rules and regulatory expectations. Today, we will dissect the joint agency guidance and the specific operational requirements that govern how your institution manages overdraft services. Managing overdraft programs effectively requires a firm grasp of both the technical systems that drive automated decisions and the legal framework that protects consumers from harm. At the center of our discussion is the joint guidance issued by federal regulators, which fundamentally shifts the focus from simple revenue generation to rigorous risk management. When we talk about automated overdraft systems, we are often looking at the algorithms that determine whether a transaction is paid and what fees are applied. These systems must be calibrated to ensure they do not become predatory, particularly concerning the frequency of charges or the way they handle continuous negative balance fees. If a customer remains in a negative state for an extended period, the assessment of daily or periodic fees can quickly lead to consumer harm, which is a significant focus area for the CFPB during supervisory exams. You must ensure that your system's order of posting, whether for checks, ACH debits, or card transactions, is transparent and does not artificially maximize fee revenue, as this is a common point of contention in regulatory findings. Under Regulation E, the opt-in requirement for automated overdraft limits for ATM and one-time debit transactions stands as a hard boundary for compliance officers to monitor. You cannot simply default customers into these services. They must provide affirmative consent, and your record retention of those opt-in elections must be bulletproof. Beyond the initial consent, the interplay between your marketing materials and actual product performance should be scrutinized for any signs of deceptive practices. If your marketing implies that overdraft protection is a standard safety feature while failing to adequately disclose the potential cost and risk of overextension, you are inviting regulatory scrutiny. Dynamic, automated limits that change based on account activity must be handled with clear, empirical logic rather than subjective or discriminatory patterns. This extends to your charge-off policies, which must remain consistent and not be used as a blunt instrument to mask larger systemic issues with your fee structure. Effective oversight of these programs demands a robust methodology for monitoring and testing that goes far beyond surface-level reviews. You should be performing regular risk assessments that incorporate statistical validity in your sampling of transactions to ensure that your monitoring algorithms are functioning as intended. If you rely on third-party vendors to manage these platforms, your due diligence must encompass their internal controls, especially regarding how they interpret and apply your board-approved policies. The board of directors needs more than just a rubber stamp on these programs. They require periodic reporting metrics that highlight not just fee income, but also complaint volume, resolution timeframes, and root cause analysis of detected anomalies. When complaints arise, the way you track and resolve them provides a window into your culture of compliance, and regulators will look closely at your corrective action planning if recurring issues appear in the data. Finally, the maintenance of policy documentation and the adaptability of your change management processes are essential to avoiding enforcement actions. Many banks struggle when they update their system parameters, but fail to update their underlying compliance policies or staff training materials to match the technical reality. Your audit testing parameters should be designed to catch discrepancies between the written policy in the actual execution of overdraft decisions on the account level. Peer bank benchmarking can be a useful tool to gauge whether your overdraft fees or usage thresholds are outliers in the marketplace, providing context that can support or temper your risk appetite. Remember that the goal is minimization of consumer harm through proactive management, statistical vigilance, and clear, honest communication with your account holders at every touchpoint. By treating overdraft protection as a disciplined risk area rather than a stagnant revenue stream, you ensure your institution remains resilient against emerging regulatory pressures. I will see you in the next session. Welcome back. In this chapter, we explore the core pillars of the Bank Secrecy Act to build a robust foundation for anti-money laundering compliance. The Bank Secrecy Act, often referred to as the Currency and Foreign Transactions Reporting Act, serves as the primary legislative vehicle through which financial institutions assist government agencies in detecting and preventing money laundering. It is not merely a set of checklists, but a framework that compels banks to create a paper trail of financial activities that could potentially be linked to illicit intent. When we discuss the architecture of this regulation, we must start with the Currency Transaction Report, or CTR, which is required for transactions in currency exceeding $10,000. The complexity arises when these transactions are split across multiple branches or accounts, leading to the requirement for aggregation. An institution must have robust system parameters to identify when a customer is intentionally structuring transactions to fall below the reporting threshold. This is a deliberate attempt to evade the requirements of the Act, and identifying this behavior requires both automated monitoring and human intuition. Exemptions from these reporting requirements are categorized into two phases, known as Phase 1 and Phase 2, which streamline the burden for entities that generate high volumes of legitimate currency transactions. Phase 1 exemptions generally apply to banks, government agencies, and entities listed on major stock exchanges, which are naturally lower risk for money laundering. Phase 2 exemptions are more nuanced, covering non-listed businesses such as retail establishments that meet specific criteria regarding their revenue and transaction activity. Managing these exemptions is not a set-it-and-forget-it task. It requires annual reviews to ensure that the customer still qualifies for the exemption status. If a business changes its operations or its ownership structure, the bank must be prepared to reevaluate the risk profile immediately. Failure to keep these records accurate can lead to significant regulatory scrutiny during an examination. Beyond simple currency reporting, the Bank Secrecy Act mandates strict adherence to the record-keeping rule and the travel rule concerning funds transfers. When a bank initiates or receives a wire transfer of $3,000 or more, it must collect and retain specified information to ensure that the origin and destination of funds are transparent. The travel rule requires that this information must travel with the transfer through the payment chain, preventing criminals from obscuring the trail by moving money through multiple intermediaries. Furthermore, banks are obligated to maintain logs for the sale of monetary instruments, such as cashier's checks or money orders, particularly when purchased with currency between $3,000 and $10,000. These logs serve as crucial forensic tools for law enforcement. Every control must be documented, and your decision-making process regarding threshold computations and exception handling must be defensible under audit. Risk assessment methodologies form the bedrock of an effective compliance program, as they dictate how resources are allocated to monitor potentially suspicious activities. A static risk assessment is insufficient in today's evolving threat landscape, so we must adopt dynamic processes that account for both geographic, customer, and product risks. Geographical targeting orders, or GTOs, are specialized tools issued by FinCEN that require financial institutions in specific areas to report transactions that would otherwise fall below normal thresholds. These orders are temporary but highly intensive, requiring real-time updates to data systems and staff training. When implementing these controls, you should focus on statistical validity within your quality assurance sampling. If you are selecting transactions for testing, ensure the methodology is representative of the entire population of transfers and currency activity, rather than focusing only on subsets that appear low risk. Finally, we must address the administrative side of the Bank Secrecy Act, particularly board reporting and enforcement action prevention. The board of directors is ultimately responsible for the institution's culture of compliance and must receive regular, meaningful metrics regarding the health of the program. This reporting should include not just raw data on the number of CTRs filed, but insights into the effectiveness of the monitoring system and the results of recent audits. If a deficiency is identified, such as a gap in record retention or a failure in the automated monitoring logic, a corrective action plan must be established with clear accountability. Root cause analysis is the most vital step here. Guessing at the cause of a control failure will only lead to recurring issues. By treating compliance as a structured engineering problem, we ensure the institution remains shielded from the reputational and financial costs of systemic failures. See you in the next lecture. Welcome back. In this chapter, we explore the anti-money laundering framework, focusing on the essential program pillars and the regulatory expectation of risk-based compliance. An effective anti-money laundering program is built upon 4 established pillars, as mandated by the Bank Secrecy Act statutes, and further reinforced by supervisory guidance. These pillars serve as the operational bedrock for any financial institution aiming to deter illicit financial activities. First, we have internal controls, which are the fundamental policies and procedures designed to ensure ongoing compliance. These must be integrated into the daily workflow of the bank, ensuring that activities are tracked, monitored, and reported correctly. Second, an institution must designate a qualified Bank Secrecy Act officer who possesses the appropriate level of authority and access to data to manage the program effectively. This individual acts as the point person for all regulatory inquiries and internal reporting. Third, mandatory personnel training requirements ensure that every employee understands their specific role in identifying and escalating suspicious behavior. Finally, the 4th pillar concerns independent testing, which involves periodic audits to evaluate the efficacy of the internal controls. Without these 4 elements functioning in concert, an institution would be viewed by examiners as having a porous defense against money laundering threats. Customer due diligence, often shortened to CDD, represents the core of our risk-based approach to account management. Since the implementation of the beneficial ownership rule, the focus has shifted toward identifying the natural persons behind legal entity customers. When we onboard a complex business client, the regulation requires us to apply 2 specific prongs. The control prong necessitates identifying one individual with significant responsibility to control, manage, or direct the legal entity. Often, this is a chief executive officer or a similar high-level manager who makes the decisions for the firm. The equity prong, on the other hand, demands identification of individuals who own 25% or more of the equity interests in the entity. Because these ownership structures can be opaque, understanding these requirements is not just a paperwork exercise, but a primary defense against shell companies. If a customer is classified as high risk, such as those in foreign correspondent banking or certain private banking sectors, the institution must escalate its effort to enhance due diligence. This requires more frequent monitoring and a deeper dive into the source of funds and the source of wealth to minimize the risk of the bank being used for money laundering. Moving beyond foundational structures, the technical environment of compliance requires careful calibration of system parameters. We often talk about threshold computations, which are the automated triggers in our monitoring systems that flag transactions for manual review. If these thresholds are configured too loosely, you will generate thousands of false positives that drown your investigators. If they are too tight, you bypass the very risks you are supposed to detect. Consequently, institutions must employ robust quality assurance protocols, often utilizing statistical sampling to ensure that the monitoring systems remain valid and defendable. When examiners arrive, they look for our ability to conduct root cause analysis when a control fails. They want to see that the issue was identified, corrected, and that a formal change management process was implemented to prevent recurrence. This involves documenting not just the error, but the policy modification or system update that resulted from the audit finding, which contributes to the institutional memory of the compliance program. External oversight and reputation management form the final piece of the puzzle, specifically regarding how a bank handles complaints and interacts with vendors. Complaint tracking should be centralized, ensuring that every grievance is logged with granular detail. We must track resolution timeframes to ensure that potential consumer harm is minimized, as regulators are highly sensitive to systemic issues that negatively impact the customer base. If we rely on third-party vendors for AML software or transaction monitoring, the bank still retains full liability for compliance failures. We must conduct rigorous third-party vendor oversight, treating the vendor's performance as if it were our own internal function. This includes peer bank benchmarking, where we measure our incident rates and monitoring metrics against industry standards to identify significant deviations. Ultimately, this framework is about penalty avoidance. By systematically documenting our processes and managing our risks proactively, we reduce the likelihood of facing severe enforcement actions. Through this methodical approach to compliance and internal rigor, you ensure the bank remains a secure and compliant entity. Talk to you in the next lecture. Welcome back. We are turning our focus to the USA PATRIOT Act and its critical intersection with your institutional compliance framework. In this chapter, we will dissect the legislative mandates that force financial institutions to act as the primary defense against global financial crime. The USA PATRIOT Act represents a fundamental shift in how financial institutions must manage international connectivity and internal surveillance. Section 311 of the Act grants the Secretary of the Treasury the authority to designate certain foreign jurisdictions, institutions, or transaction classes as primary money laundering concerns, which mandates special measures to mitigate those risks. When such a designation occurs, your institution may be required to impose specific conditions, such as prohibiting the opening of correspondent accounts or requiring heightened due diligence before processing transactions. These measures essentially act as a prophylactic barrier, preventing illicit foreign actors from polluting the domestic financial system. Understanding the exact thresholds for these special measures requires careful monitoring of the Treasury's Financial Crimes Enforcement Network alerts. You are not only expected to know these lists, but also to integrate them into your automated filtering systems to ensure seamless blockage of prohibited activity. Ignoring these designations can lead to significant regulatory enforcement actions, making this a foundational pillar of your compliance program. Moving into correspondent and private banking accounts. Section 312 mandates specific due diligence procedures for correspondent accounts held by foreign financial institutions and private banking accounts held by non-United States persons. The core principle here is transparency, meaning you must identify the owners of these accounts, assess their money laundering risk profile, and apply ongoing monitoring to detect suspicious activity. It is not sufficient to simply perform initial due diligence. You must maintain a periodic review process that considers the volume and nature of the transactions relative to the account profile. If a foreign bank maintains correspondent accounts for other entities, your institution must also evaluate the anti-money laundering controls of that bank to ensure you are not indirectly facilitating activities that would be illegal in the United States. This nested risk requires a robust audit trail that demonstrates how you evaluate, approve, and monitor these relationships over time. You should document these assessments with enough granularity to provide a clear narrative to an examiner regarding how you gatekeep access to the U.S. financial system. A significant component of the Act is the outright prohibition on shell banks, as detailed in Section 313. By definition, a shell bank is a foreign bank that has no physical presence in any country, meaning it lacks a fixed address, staff, and meaningful supervision. The law requires you to take reasonable steps to ensure that your foreign correspondent accounts are not being used to provide services to these illicit entities. This necessitates a formal attestation or certification process where the foreign bank declares its compliance status regarding shell bank relationships. Simply taking a client's word is rarely enough, as you must maintain periodic updates to these certifications and cross-verify them against known industry information. Should you discover that a correspondent bank is indirectly providing services to a shell bank, the regulation compels you to terminate the relationship to avoid severe legal exposure. Effective record retention for these certifications is not just an administrative task, but a critical defense in the event of an audit. Information sharing, defined under Sections 314A and 314B, provides a structured mechanism for cooperation between law enforcement and the financial industry. Section 314A allows federal, state, and local law enforcement agencies to reach out to institutions to identify suspected money launderers or terrorists efficiently. You are required to perform a thorough search of your records based on agency requests and report any matches promptly, ensuring the integrity of the information sharing channel. Conversely, Section 314B facilitates voluntary information sharing between financial institutions to identify and report activities that may involve potential money laundering or terrorist financing. The benefit here is the safe harbor provision, which protects your institution from civil liability for sharing information, provided you use it exclusively for the purposes authorized by the Act. To leverage this properly, You must establish clear internal policies that define how information is received, processed, and shared, while ensuring your staff maintains strict confidentiality regarding the inquiries. The final aspect of our discussion involves subpoenas for foreign bank records, which empowers the Attorney General or the Secretary of the Treasury to demand records pertaining to correspondent accounts. If you maintain a correspondent account for a foreign bank, you must keep records of the owners of that foreign bank and the name of an agent in the United States authorized to accept service of legal process. If the foreign bank fails to comply with a subpoena regarding these records, the Act mandates that you terminate the correspondent relationship. This is an absolute requirement that brooks no leeway, forcing you to act as an agent of regulatory enforcement on behalf of the government. Your compliance management system must include workflows that trigger relationship termination if the foreign bank does not provide the required documentation or legal cooperation. This entire framework reinforces the role of the institution as the first line of defense in protecting market integrity through rigorous surveillance and decisive action. We'll see you in the next lecture. Welcome to this exploration of the Office of Foreign Assets Control, where we will examine the regulatory framework governing economic sanctions. In this module, we will deconstruct the mechanics of compliance that protect the institution from international financial risks. The Office of Foreign Assets Control, or OFAC, operates under the United States Department of the Treasury to enforce economic and trade sanctions based on U.S. foreign policy and national security goals. As a compliance professional, it is essential to understand that these regulations are not static, as they evolve rapidly in response to geopolitical shifts. Unlike many other consumer lending laws, OFAC sanctions occupy a unique space, where the primary objective is to restrict financial access to specific countries, entities, and individuals labeled as specially designated nationals or blocked persons. The statutory authority for these programs is primarily derived from the International Emergency Economic Powers Act, which grants the executive branch broad powers to regulate commerce in response to unusual and extraordinary threats. Compliance requires more than just a surface-level policy. It demands that we integrate screening processes into the DNA of the institution's transaction lifecycle. When a transaction involves a party on the SDN list, the institution is legally obligated to block the assets and file a report with OFAC, rather than simply refusing to process the payment. This distinction is subtle but critical, as reporting requirements vary based on the specific sanctions program tied to the sanctioned party. One of the most complex areas of OFAC compliance is the 50% rule, which dictates that an entity is considered blocked if one or more sanctioned parties own, in the aggregate, 50% or more of that entity. This rule applies even if the entity itself does not appear by name on the SDN list, creating a significant challenge for ongoing customer due diligence and vendor oversight. Screening processes must therefore go beyond binary name matching and incorporate sophisticated entity resolution to uncover hidden ownership structures. We often encounter false positives in our filtering software, where legitimate transactions are flagged due to name similarities with blocked individuals. The challenge here is to develop a validation process that reduces noise without creating a permissive environment that invites regulatory scrutiny. Effective software validation ensures that our systems are calibrated to detect relevant hits while providing a documented audit trail for why certain alerts were dismissed as false positives. If our risk assessment methodology fails to capture the complexity of our customer base, we are essentially blind to the potential for severe civil and criminal penalties enforcement actions often impose. Moving beyond the technical implementation of screening software, we must focus on the operational controls that support our broader risk posture. This involves a rigorous assessment of the bank's exposure based on our geographic reach, the nature of our products, and the complexity of our customer demographic. An effective risk assessment is not a static document, but a living model that informs our policy documentation and our workflow controls. For example, when we determine that high-risk regions are a part of our transactional volume, we must implement automated thresholds for transaction monitoring that trigger enhanced due diligence. Furthermore, we need a robust system for record retention that spans years, ensuring that every decision regarding a rejected transaction is defensible during an examination. The examination manual procedures provide the baseline for what regulators expect, But the reality is that our audit testing parameters must be more stringent than the minimum requirements to provide a safety margin. We must also consider the third-party vendor oversight aspect, as we remain ultimately liable for the screening gaps that a vendor might create within our outsourced payments infrastructure. The maturation of a compliance program is reflected in the reporting metrics provided to the Board of Directors. Board reporting should be focused on the narrative of risk, identifying trends and sanction hits, the resolution timeframes for these alerts, and any gaps identified by quality assurance sampling. Statistical validity in our sampling processes is a point of contention during audits. It is insufficient to review random files if those files do not cover the high-risk segments of our customer base. We must look for root cause analysis when a compliance failure occurs, focusing on how the gap manifested in the change management processes or the initial onboarding stage. Corrective action planning must be immediate and documented, as regulators look for evidence that the institution is proactive in its remediation efforts rather than reactive to discovered errors. Finally, we need to consider the consumer harm minimization aspect, ensuring that our blocking procedures do not lead to unfair treatment of legitimate customers, which requires a balance between strict enforcement and operational fairness. Peer bank benchmarking is a helpful tool here, allowing us to align our thresholds with industry standards while maintaining a defensible and distinct risk appetite. See you in the next lecture. Hello, welcome back. Today, we turn our attention to the Customer Identification Program requirements, a foundational pillar of identity verification for financial institutions. The Customer Identification Program, frequently referred to as CIP, is a mandatory component of an effective anti-money laundering framework mandated under Section 326 of the USA PATRIOT Act. At its core, the policy requires a financial institution to implement reasonable procedures to verify the identity of any person seeking to open an account to the extent reasonable and practicable. Before a customer can be effectively onboarded, the bank must collect a specific set of minimum identifying information, including the customer's legal name, date of birth, their residential or business address, and an identification number. This number is typically a taxpayer identification number for United States persons, such as a Social Security number, or an alternative government-issued number such as a passport or alien identification card for non-U.S. persons. The primary objective here is to form a reasonable belief that the institution knows the true identity of each customer. You must remember that this requirement is not a one-time check, but a systematic process integrated into the bank's operational workflow. Without a robust CIP, an institution remains structurally vulnerable to unauthorized access and potential illicit activity originating from disguised identities. Once the information is collected, the institution must perform verification using either documentary or non-documentary methods, or a carefully calibrated combination of both. Documentary verification involves reviewing unexpired government-issued identification that bears a photograph or similar safeguard, such as a driver's license or passport. When documents are unavailable or insufficient to establish certainty, non-documentary methods become necessary, which often involve comparing the provided information against consumer reporting agencies, public databases, or credit reports. These methods must be robust enough to manage the risk of fraud while remaining efficient enough to facilitate reasonable business operations. For legal entities, the process extends beyond a simple person-to-person verification to include an assessment of the business structure and authorization. Banks must determine whether the business is legitimate and confirm that the individual opening the account possesses the requisite authority to act on behalf of that entity. This often necessitates checking articles of incorporation, government business registries, or other organizational documentation that confirms the entity's standing. Record-keeping and retention are just as vital as the verification itself, as regulators will prioritize these during an examination. An institution is required to retain records of the information used to identify the customer for at least 5 years after the account is closed. This retention window ensures that if law enforcement eventually identifies suspicious activity, the paper trail leading back to the account opening remains intact for investigative purposes. Beyond simple storage, institutions must establish clear discrepancy resolution protocols for when the provided information does not match the results of the verification process. Should a situation arise where identity cannot be verified, the bank must have a documented workflow that dictates whether the account should be opened, restricted, or denied entirely. Furthermore, The bank must provide adequate notice to customers that the institution is requesting information to verify their identity, typically through signage or disclosures during the account opening process. Such notice ensures the institution remains compliant while maintaining transparency about why identity data is being collected and scrutinized. Reliability and operational oversight define the distinction between a compliant program and one that merely exists on paper. While institutions may on rare occasions rely on other financial institutions to perform CIP tasks, the ultimate responsibility for compliance remains squarely with the bank providing the service to the customer. This reliance must be governed by contractual arrangements that ensure the third party strictly follows the bank's own internal standards regarding identity verification. Effective risk assessment methodologies must constantly evaluate the effectiveness of these controls, especially as new digital account opening channels create higher susceptibility to synthetic identity fraud. Statistical validity and sampling is essential during audit testing or quality assurance reviews to determine if the controls are functioning as intended across different product lines. When testing identifies gaps, a root cause analysis must be initiated to inform corrective action plans or system adjustments, ultimately minimizing consumer harm and regulatory penalties. Board reporting metrics and quality assurance workflows serve as the final layer of defense, ensuring that senior management remains informed of potential systematic failures or recurring discrepancies in the identification process. See you in the next session. Welcome back to our exploration of the regulatory landscape. Today, we begin our focused examination of suspicious activity reports, a critical pillar of your institutional compliance framework. In this chapter, we will dissect the mechanical and statutory requirements governing the filing of suspicious activity reports, commonly known as SARs. You will master the nuances of mandatory reporting triggers, the protection afforded by safe harbor provisions, and the absolute prohibition against tipping off subjects. By the time we conclude this section, you will possess the expertise to translate complex regulatory expectations into robust internal controls, ensuring your institution remains proactive rather than reactive in its financial crime mitigation strategies. The foundation of the suspicious activity report process is the requirement to identify and report transactions that may involve money laundering or other illegal activities. Under the Bank Secrecy Act and its subsequent amendments, financial institutions are mandated to file a SAR whenever they detect a transaction that is conducted by, at, or through the institution and involves potential criminal activity. The thresholds are specific. You must file if the activity involves insider abuse of any amount, or if it involves a total of $5,000 or more when a suspect is identified. If there is no identified suspect, the threshold for mandatory reporting shifts to $25,000 or more. These figures serve as primary indicators, but you must remember that the core of the obligation lies in the qualitative assessment of suspicion, regardless of the dollar amount, in cases where the institution suspects a violation of federal law. Structuring is a classic example of activity that necessitates a SAR filing, where an individual intentionally breaks up transactions to bypass filing thresholds. The regulation requires you to look beyond the surface level of a transaction to understand the intent and the underlying story of the customer. Computer intrusions and instances of identity theft also fall under these requirements, and your reporting workflow must be agile enough to capture these distinct categories. The concept of safe harbor is vital here. It provides legal protection to institutions that file SARs in good faith, shielding them from civil liability for reporting potentially criminal conduct. This protection is not a suggestion, but a legal safeguard designed to encourage transparency without the paralyzing fear of litigation from the parties whose activities were scrutinized. Confidentiality of these filings is perhaps the most strictly enforced aspect of the regulatory framework, explicitly embodied in the no tipping off rule. You are legally forbidden from disclosing to any person involved in the transaction that a SAR has been filed or that the information was provided to law enforcement. This means your communication channels, including board notifications, must be carefully designed to report on the existence of these filings in aggregate without compromising individual law enforcement investigations. While the board needs to know that the compliance program is effectively identifying elevated risks, they must never be privy to the specifics that would constitute a breach of this confidentiality. Maintaining this balance requires a rigorous, compartmentalized approach to documentation and internal reporting metrics. When it comes to the logistics of filing, the FinCEN e-filing system is the mandatory conduit through which these reports must reach regulators. Filing a SAR is not merely a box-checking exercise. It is an act of cooperation with the broader security apparatus, and it requires precise attention to timing. You are generally required to file a report within 30 days of the date of the initial detection of facts that may constitute a basis for filing. If no suspect is identified on the date of detection, you have an additional 30 days to attempt to identify the culprit before the clock officially starts. For ongoing activity, you must evaluate the need for a continuing activity report every 90 days after the date of the initial SAR filing, keeping the authorities appraised of persistent patterns. The integrity of your SAR process deepens when you integrate root cause analysis and statistical sampling into your quality assurance protocols. You must move past simply filing individual reports and consider your system parameters, ensuring that your automated red flags are calibrated to the actual risk profile of your customer base. Peer bank benchmarking is a useful exercise to ensure your filing volume is not an outlier, as either significantly higher or lower volume relative to similarly sized institutions can trigger supervisory scrutiny. Furthermore, your third-party vendor oversight regarding monitoring software is crucial. You are ultimately responsible for the validity of the data and the logic used by these tools. Your audit testing should systematically review a sample of transactions to verify that the workflow controls are functioning as intended and that no suspicious activity is slipping through the cracks. Effective policy documentation is the bedrock upon which all these procedural requirements rest, as it demonstrates to examiners that your institution has a sound approach to governance. Your documentation must clearly articulate how your institution defines suspicious behavior, how these definitions are updated in response to new enforcement actions, and how the decision-making process is handled. Every decision not to file a SAR should be as thoroughly documented as a decision to file one, providing a clear rationale for the exclusion for future review. Complaint tracking is another vital data point, as consumer complaints often highlight unusual account activity that should lead to an internal review process. This comprehensive approach minimizes consumer harm, ensures regulatory compliance, and protects the firm from potentially severe enforcement actions following a systemic failure. See you in the next lecture. Welcome to our exploration of the Gramm-Leach-Bliley Act, where we will examine the regulatory requirements surrounding the privacy of consumer financial information. This study will equip you with the essential knowledge needed to master the technical details and practical applications of GLBA compliance for your certification. The Gramm-Leach-Bliley Act, specifically Regulation P, fundamentally changed how financial institutions handle non-public personal information. At the heart of this regulation is the distinction between a consumer and a customer, a classification that dictates your disclosure obligations. A consumer is an individual who obtains a financial product or service that is to be used primarily for personal, family, or household purposes. Contrastingly, a customer is a consumer who has a continuing relationship with the institution. You must recognize that this continuing relationship is the trigger for providing annual privacy notices, whereas a one-off transaction might only require an initial notice. If you fail to categorize these individuals correctly, you risk significant compliance gaps in your delivery methods for privacy disclosures. The statute requires that these notices be clear, conspicuous, and provided in a manner that the consumer can reasonably be expected to receive. Managing how information flows to non-affiliated third parties is an equally critical component of your operational framework. Under Regulation P, institutions must provide customers a reasonable opportunity to opt out of the sharing of their non-public personal information with these outside entities. The mechanism for this opt-out must be simple and easily accessible, such as a toll-free number or a pre-addressed form. However, there are significant exceptions to this rule, most notably the exception for joint marketing agreements. You should be aware that institutions can share information with companies that perform services for them, provided there is a contractual agreement ensuring the third party maintains the confidentiality of the data. Furthermore, the sharing of information among corporate affiliates is generally excluded from the opt-out requirements by the Fair Credit Reporting Act, which interacts closely with GLBA provisions. Mastering these nuances allows a bank to leverage internal data while remaining strictly within the boundaries of permissible disclosure. When moving toward robust institutional compliance, you must consider the practical application of the model privacy form provided by the regulators. This standardized form is designed to provide safe harbor protections, assuming the institution fills it out according to the specified instructions. Beyond the form itself, your board of directors must receive regular reporting regarding the effectiveness of your privacy program. This is not merely an exercise in paperwork, but a way to quantify risk through specific metrics and threshold computations that demonstrate your control environment to examiners. For instance, if you are conducting audit testing, your parameters should focus on sample sizes that provide statistical validity. If your quality assurance protocols reveal a pattern of non-compliance, you are expected to trigger a root cause analysis to inform your corrective action planning. This proactive approach to change management ensures that privacy controls are updated alongside shifts in digital banking products and third-party vendor relationships. Effective oversight also requires a rigorous approach to complaint management and consumer harm minimization. If a customer files a complaint regarding a privacy breach, the speed and efficacy of your resolution timeframes serve as a primary indicator of your compliance maturity. You should view these complaints as data points that feed into your overall risk assessment methodology, rather than isolated events to be managed in a silo. Enforcement action precedent suggests that regulators pay close attention to how boards document their oversight of privacy policies and whether those policies are actually reflected in operational workflows. By maintaining a clean record retention system and benchmarking your performance against peer banks, you establish a defensible audit trail. Remember that your goal is to minimize actual consumer harm, as that is the standard by which modern regulatory bodies ultimately measure the success of your GLBA program. We shall continue our study of privacy standards in the next session. Welcome back. In this session, we will examine the Right to Financial Privacy Act and the specific constraints it places on federal government access to customer financial records. The Right to Financial Privacy Act, or RFPA, establishes a framework designed to protect the confidentiality of personal financial records held by financial institutions from unwarranted intrusion by federal government authorities. At its core, the Act essentially balances the government's legitimate need for information in investigations against the consumer's expectation of bank secrecy. Under this statute, financial institutions are generally prohibited from providing federal government agencies with access to or copies of customer records unless the agency presents a specific legal process. This legal process takes several forms, including administrative subpoenas, search warrants, judicial subpoenas, or formal written requests, each carrying distinct procedural requirements. When a government authority seeks records, they must typically provide the financial institution with a certificate of compliance, indicating that they have satisfied the applicable requirements of the RFPA. If your institution is forced to pull records for these purposes, the Act even includes provisions for cost reimbursement to the bank for the labor and materials required to assemble and produce the requested documentation. While the Act is relatively robust, it is the exceptions that often create the most complexity in a daily banking environment. For instance, the disclosure of records is often permissible when an agency provides a specific type of legal process. Yet it is equally important to understand where the RFPA does not apply at all. One of the primary carve-outs involves grand jury subpoenas, which are exempt from many of the notice and challenge procedures that would otherwise apply to other types of legal requests. Similarly, the IRS is granted specific authority through its own summons process, which functions differently from standard RFPA requirements. Furthermore, when your institution suspects criminal activity and files a Suspicious Activity Report, or SAR, the RFPA specifically allows for these disclosures without triggering the standard notification requirements for the customer. This interaction with the USA PATRIOT Act and anti-money laundering obligations is critical, as it ensures that banks are not held liable for tipping off customers when reporting potentially illicit activity to enforcement agencies. Managing this risk requires a structured internal approach that goes well beyond simply checking if a document looks official. You should focus on establishing clear workflow controls that define exactly who is authorized to receive, review, and fulfill requests for customer documentation. A sound risk assessment methodology must evaluate the likelihood of improper disclosure, which could lead to significant penalties and reputational damage for the institution. Your policy documentation should clearly outline the step-by-step procedures employees must follow when presented with any government request. This includes verifying the form of the subpoena and ensuring that the internal retention rules are followed strictly once the records are produced. I have seen many institutions fail because their frontline staff lack the training to distinguish between a valid judicial subpoena and a request that failed to meet the necessary legal threshold. By incorporating these controls into your overarching compliance management system, you ensure that the bank remains a partner to law enforcement without compromising its fundamental promise of privacy to the account holders. Beyond the technical requirements, you also need to incorporate robust monitoring and audit testing parameters to ensure your controls remain effective over time. This involves periodic statistical sampling of produced records to ensure that the required certifications were received and that the produced information did not exceed the scope of the legal demand. You should track these interactions in a complaint management system or a dedicated disclosure log to identify any patterns or anomalies in government requests. If an internal audit identifies that staff provided data without proper certification, you must initiate immediate corrective action and root cause analysis to determine why the process failed. When you prepare reporting metrics for your board, highlight the volume of government requests handled, the success of your verification procedures, and the status of any recent training initiatives. This data-driven approach allows you to demonstrate effective oversight and ensures that you are actively minimizing consumer harm through strict adherence to statutory limitations. Lastly, consider the perspective of a regulator who is reviewing your institution's performance against the RFPA during an examination. They will look for evidence that your change management processes account for updates to agency interpretations and supervisory guidance. If you operate in a sector that involves significant third-party vendor oversight, ensure that any vendors handling document production on your behalf are held to the same high standards of confidentiality and privacy. Benchmarking your procedures against your peers can often reveal gaps in your internal processes that you might not otherwise consider. Remember that consistent, repeatable quality assurance is the best defense against enforcement actions or administrative findings. By fostering a culture of compliance where every staff member understands the importance of the confidentiality mandate, you effectively lower the risk that personal data will be inappropriately exposed during a government inquiry. See you in the next lecture. Welcome to this chapter on the Children's Online Privacy Protection Act, often abbreviated as COPPA, where we will examine the regulatory landscape governing the collection of personal information from children under the age of 13. We will focus on the practical application of these rules to ensure your institution maintains complete compliance. The Children's Online Privacy Protection Act is a federal statute designed to place parents in control over what information is collected from their young children online. When an institution operates a website or an online service directed to children under 13, or possesses actual knowledge that it is collecting personal information from a child in that age bracket, the requirements of the rule are triggered. The core of this regulation is the mandate to provide clear notice and obtain verifiable parental consent before any data collection occurs. You must view this not as a mere checkbox exercise, but as a fundamental framework for data minimization. If you do not strictly need the data to facilitate the activity, you should not be collecting it in the first place, as this reduces your institutional risk footprint significantly. Verifiable parental consent is the cornerstone of COPPA compliance, and the Federal Trade Commission has outlined several acceptable mechanisms to achieve it. Traditional methods include providing a form to be signed and returned by mail or fax, though digital signatures supported by reliable identity verification are increasingly common. The goal is to ensure with reasonable certainty that the individual providing consent is indeed the parent or legal guardian of the child. Your institution must also maintain a clear and comprehensive privacy policy that explicitly states its practices regarding the collection, use, and disclosure of children's personal information. These disclosures must be prominent and easily accessible, ensuring that parents are fully informed about how their child's data is siloed, protected, or potentially shared with third-party service providers. Data retention limits are an equally critical component of your operational strategy under COPPA. You are prohibited from retaining personal information for any longer than is reasonably necessary to fulfill the purpose for which the information was collected. Once the purpose is satisfied, the data must be deleted using secure methods that ensure it cannot be reconstructed or retrieved. Furthermore, parents carry the right to review the specific personal information collected from their child and may demand its immediate deletion from your records. You must establish internal workflows that prioritize these requests, as failing to honor a parental right to review or erase data can lead to significant scrutiny during a regulatory examination. Considering third-party sharing, you must exercise stringent oversight to ensure that your vendors are as compliant as your internal operations. If a service provider collects data on your behalf, they must adhere to the same privacy standards, and your agreements must explicitly limit their use of that data to the services provided for your institution. For organizations looking for additional assurance, safe harbor programs offered by industry groups can provide a structured framework for compliance. Participating in these programs does not absolve you of responsibility, but it can provide a validated pathway for demonstrating that your privacy practices meet the high standards expected by regulators and protecting your reputation from potential enforcement actions. Managing compliance in this area requires a robust risk assessment methodology that accounts for threshold computations regarding your digital exposure. You should subject your child-facing platforms to regular audit testing, gathering empirical evidence to prove that your controls are functioning as intended. This includes statistical validity in your quality assurance sampling, ensuring that your review covers a representative portion of the information flow. Your complaint tracking systems must also be tuned to identify patterns related to privacy concerns, allowing for rapid root cause analysis if a potential breach is detected. By integrating these practices into your broader change management processes, you ensure that any update to your website or mobile application doesn't inadvertently bypass established protective parameters. Reporting metrics to the board serves as the final layer of accountability, demonstrating to directors that your institution is managing its privacy risks proactively. These reports should focus on the effectiveness of your internal controls, the status of data retention schedules, and the outcome of any third-party vendor oversight reviews. Maintaining detailed records of your compliance efforts, including training materials for staff and documentation of consent mechanisms, provides a clear audit trail for regulators. Should an enforcement action occur, the precedent analysis of your previous compliance performance will weigh heavily on the outcome. By focusing on consumer harm minimization and maintaining high-quality assurance standards, you position your institution to navigate the complexities of online privacy regulation with confidence. We'll see you in the next lecture. Welcome to this exploration of information security standards, where we will examine the regulatory expectations for protecting customer data. In this lecture, we will deconstruct the interagency guidelines, establishing information security standards, and the practical application of administrative, technical, and physical safeguards. The foundation of any robust information security program rests on the expectation that financial institutions maintain a comprehensive risk assessment process. You cannot protect what you have not identified. So this starts by categorizing the types of data the institution handles, where that data resides, and the specific threats that could compromise the confidentiality, integrity, or availability of that information. Once these risks are mapped, you move into the three pillars of safeguarding: administrative, technical, and physical controls. Administrative safeguards include the policies and procedures that govern employee behavior, such as mandatory security awareness training and clear documentation of how data should be handled during daily workflows. Technical safeguards encompass the digital defenses, such as encryption at rest and in transit, robust access controls that follow the principle of least privilege, and the implementation of multi-factor authentication. Physical safeguards are often overlooked in digital conversations, but they remain a regulatory priority, requiring restricted access to data centers, locked server cabinets, and secure destruction of printed records. Risk management is not a static endeavor. It requires continuous monitoring and a proactive incident response plan. Regulations expect institutions to demonstrate an active posture, meaning you are not just setting up a firewall and walking away, but rather observing logs and alerts for patterns that deviate from normal activity. When a security event occurs, your incident response plan must clearly delineate roles and responsibilities, ensuring everyone knows how to contain the threat and at what point the legal thresholds for customer notification are triggered. A critical component of this is vendor oversight, as the security posture of your third-party providers is often indistinguishable from your own in the eyes of the regulators. You must conduct thorough due diligence and ongoing monitoring of these services, ensuring their security standards align with your own contractual expectations and the overarching regulatory guidance provided by the agencies. Governance at the highest level is essential, which is why board reporting and oversight are emphasized as central requirements. The board of directors or an appropriate committee must receive regular reports regarding the security program's status, the results of risk assessments, and the outcomes of any testing or audit activities. These reports serve to ensure that security is not just an IT department concern, but an institutional priority backed by the necessary budget and resources. Furthermore, the regulatory expectation regarding cyber hygiene protocols involves maintaining systems through regular patching, configuration management, and the removal of legacy software that no longer receives security updates. If you cannot provide evidence that your systems are kept current and that your controls are effectively functioning, you lack the baseline evidence required for a favorable examination outcome. The regulatory framework further necessitates a rigorous approach to record retention and the systematic analysis of security failures. When an incident occurs, regulatory expectations demand a root cause analysis to determine why the control failed and what corrective action is necessary to prevent a recurrence. This is closely tied to change management processes. You must ensure that modifications to systems are vetted for security implications before they are pushed live to the production environment. Furthermore, when dealing with third-party vendors, the quality assurance process must include statistical validity in your sampling methods to ensure that your verification of their security claims is actually representative of the services they provide. By maintaining this level of granular detail in your documentation, you position the institution not only to satisfy exam requirements, but to genuinely minimize consumer harm. Statistical validity in your monitoring and testing parameters is a concept that often surfaces during enforcement action analysis and peer bank benchmarking. Regulators look for evidence that your auditing methods are robust enough to catch patterns, such as unresolved customer complaints that might point to a wider information security vulnerability. If you notice an uptick in complaints related to unauthorized account changes, your response should be a targeted review of that specific workflow to identify if an access control or authentication loophole exists. This cycle of monitoring, identifying, and remediating is what defines a mature compliance posture. By anchoring your actions in these formal information security standards, you create a defensible and transparent trail of logic that satisfies the rigorous scrutiny of federal examiners during their on-site reviews. I will see you in the next lecture. Welcome to the chapter on identity theft red flags, where we will examine the regulatory requirements for preventing and detecting identity theft. We will cover the specific mandates under the red flags rule and establish how institutions must calibrate their prevention programs. The red flags rule, originating from the Fair and Accurate Credit Transactions Act of 2003, requires financial institutions to develop and implement a written identity theft prevention program. At its core, the regulation focuses on identifying, detecting, and responding to patterns, practices, or specific activities that indicate the possible existence of identity theft. This is not merely a box-ticking exercise. It involves a risk-based approach that forces the institution to look at its specific product offerings and client base. You must categorize your services into covered accounts, which are defined as accounts primarily for personal, family, or household purposes that involve multiple payments or transactions. Once you identify these accounts, you must build a program that is appropriate to the size and complexity of your institution. This requires formal board approval, as the board of directors or an appropriate committee must take responsibility for the initial oversight of the compliance program. Without active board involvement, you risk failing the fundamental requirement of governance in your control framework. Identifying relevant red flags requires a deep dive into the types of accounts you offer and the way you interact with customers. A red flag can manifest as a discrepancy in documentation, such as identification that looks altered or forged, or a photo that does not match the person presenting it. Other signals often involve suspicious personal identifying information, such as an address that does not match public records, or a social security number that has been reported as misused. Unusual account activity is a critical category, where you might see a sudden influx of small transactions followed by a massive withdrawal, or an account that has been dormant for years suddenly being used for high-frequency transfers. When these patterns emerge, your staff must have the tools and training to link these signals back to potential identity theft. You should consider the source of the information, the suspicious nature of the request, and the potential impact on the consumer when determining if a specific event qualifies as a reportable red flag. Remember that this is an iterative process, What constitutes a red flag today may change as criminals develop new techniques for circumventing traditional security barriers. Responding to red flags effectively necessitates a clear internal policy that defines the exact steps an employee must take when they detect an anomaly. Your response could range from monitoring the account for evidence of further fraud to contacting the customer directly to verify the transaction. In severe instances, you may need to close the account or notify law enforcement if you believe a crime has occurred. It is equally vital that your program is not static, as the requirement mandates periodic updates to remain responsive to emerging threats. You are expected to conduct ongoing risk assessments to determine if your current controls are sufficient or if they need to be augmented based on recent fraud trends. If you engage service providers to perform functions on your behalf, you must ensure that they have adequate measures in place to comply with the red flags rule as well. This extends the burden of oversight, as you are ultimately responsible for the actions of your third-party vendors when they interact with your covered accounts or the customers associated with them. The documentation of your program should be granular enough to support audit testing and examination procedures. You need to maintain records of your risk assessment methodologies, which serve as the foundation for identifying which accounts fall under your program. When you perform audit testing, focusing on the quality assurance of your identification process is key. This includes statistical sampling to determine if employees are adhering to the established red flags workflows and if suspicious activity is being escalated according to policy. You should also develop and monitor specific metrics that are reported to the board, which might include the frequency of red flag triggers and the outcome of the respective investigations. These metrics allow the board to verify that the compliance management system is functioning as intended rather than just being a document that sits on a shelf. Effective governance also includes clear penalty avoidance strategies, which are best achieved by demonstrating a history of proactive compliance and a robust response mechanism to every detected incident. Finally, address the operational side of your program by considering workflow controls and system parameters that can automatically flag transactions for human review. These technical controls serve as your first line of defense, reducing reliance on manual oversight that is inherently prone to error. Make sure your complaint tracking systems are integrated with your red flags detection, as customer complaints often serve as the first warning that an account has been compromised. Root cause analysis is essential here. If you repeatedly see the same types of fraud, your existing preventative measures are likely deficient and require a change management process to address the underlying vulnerability. Finally, satisfy your record retention rules by keeping detailed logs of your investigations and the steps taken to resolve them. This ensures that when auditors ask for proof of your compliance during a regulatory exam, you can provide a complete trail of your activities. Consistent, well-documented responses confirm to regulators that you have minimized potential consumer harm through a mature, risk-aware compliance culture. See you in the next lecture. Welcome to this deep dive into the evolving landscape of consumer privacy disclosures, where we will examine the intersection of state-level requirements and sophisticated data management. We are moving beyond the traditional federal frameworks to analyze the modern obligations of financial institutions regarding data handling, consumer rights, and technical infrastructure. The shift towards state-level privacy mandates, most notably initiated by the California Consumer Privacy Act and subsequently expanded by the California Privacy Rights Act, has fundamentally altered how banks must view their data ecosystems. Unlike the older principles-based federal laws, these statutes introduce granular requirements for disclosure that demand a high degree of technical precision. You must now distinguish clearly between opt-in and opt-out regimes, as the statutory trigger often depends on the specific nature of the data processing activity rather than the nature of the institution itself. Global privacy controls are no longer optional suggestions, as regulators increasingly expect that automated signals from consumer browsers regarding data sharing are honored without human intervention. This necessitates a robust data mapping exercise, as it is impossible to fulfill a request to know or delete data if you cannot locate every instance of a specific consumer's information across your internal silos and third-party vendor systems. Managing data brokers and the sharing of information for cross-context behavioral advertising requires a level of oversight that many compliance programs struggle to maintain. You are required to perform a rigorous risk assessment to determine if your platform configurations act as a conduit for tracking that triggers these specific disclosure obligations. When a consumer submits a request to know, delete, or correct their personal information, the compliance clock starts immediately, demanding an audit-ready workflow that ensures responses are both timely and accurate. Security incident disclosures and breach notification laws add another layer of complexity, as you must align your internal incident response policy with the notification timelines set by various state attorneys general. Beyond the technical implementation, these processes must be codified in comprehensive documentation that demonstrates your policy alignment to regulators during an examination. This is not merely about having a privacy policy on your website. It is about maintaining a dynamic, evidence-based management system. The operational reality of these privacy disclosures hinges on the ability to quantify and report metrics to your board of directors. You should implement automated threshold computations to identify when specific data processing activities shift from standard internal usage to high-risk sharing scenarios that trigger enhanced disclosure requirements. Penalty avoidance is a primary business goal, yet this cannot be achieved without a rigorous quality assurance program that utilizes statistical sampling to verify the accuracy of your privacy reporting. Complaint tracking is another critical component, as regulators will look for resolution timeframes and evidence of root cause analysis when evaluating your consumer protection maturity. If a consumer concern regarding data privacy remains unaddressed, it often signals a failure in your change management process or a lack of oversight regarding third-party vendors. To ensure you are well prepared for any regulatory inquiry, focus your benchmarking efforts on how your institutional practices compare to peer banks of similar size and data complexity. You must account for consumer harm minimization in every step of your data lifecycle, prioritizing data minimization over data accessibility whenever possible. Record retention is a specific area of peril, as you must maintain proof of disclosure delivery and consumer consent in a way that remains searchable and reconcilable over many years. When regulators conduct an audit, they will look for concrete evidence of your corrective action planning, meaning that privacy breaches or near misses must be documented with a clear path towards system hardening. Ultimately, your documentation must bridge the gap between abstract policy mandates and the technical realities of your bank's database architecture. See you in the next lecture. Welcome to our exploration of compliance management systems, the foundational architecture that sustains a culture of adherence within any financial institution. In this chapter, we will master the structural components and operational methodologies required to manage regulatory risk effectively and demonstrate commitment to consumer protection. A robust compliance management system, or CMS, is not merely a collection of isolated policies, but rather an integrated framework that permeates every level of the organization. At its core, the system requires clear board and management oversight, which serves as the top-down directive for risk appetite and institutional behavior. When the board actively reviews compliance reports and allocates appropriate resources, they signal that compliance is a strategic necessity rather than a secondary back-office function. The structural integrity of this system relies on the interplay between written policies, procedural controls, and the human element represented by staff training. Without these pillars, even the most sophisticated automated systems will fail to prevent regulatory drift or the accumulation of systemic risk. We look at the CMS as the nervous system of the bank, where sensory inputs from monitoring activities trigger corrective reflexes before regulatory damage occurs. This is precisely how institutions avoid the cascading effects of non-compliance, such as administrative enforcement actions or public reputational harm. By treating the CMS as a living organism rather than a static document, you allow the institution to evolve alongside changing regulatory expectations. Effective compliance risk management begins with the granularity of your risk assessment methodologies. You must objectively identify sources of potential non-compliance across the entirety of your product lifecycle, starting from initial design through to delivery and sunsetting of services. If you introduce a new mortgage product, the risk methodology must account for disclosure requirements, fair lending implications, and potential operational bottlenecks. This involves mapping regulatory requirements to specific internal workflows, ensuring that threshold computations, such as those defining high-priced mortgage loans, are hard-coded into your system parameters. Statistical validity in your monitoring activities becomes essential here, as subjective sampling rarely provides the evidence base required during a rigorous regulatory examination. Instead, You should aim for a risk-based sampling approach where high-risk areas receive heightened frequency and depth of testing. This rigorous approach to data ensures that when you report upward to the board, your metrics are not just anecdotal, but supported by verifiable audit trails. Third-party vendor management represents a high-stakes arena where the bank directly inherits the compliance failures of its service providers. The regulatory expectation is that you oversee your vendors with the same level of scrutiny that you apply to internal departments, particularly regarding data security and consumer interaction. This means your vendor oversight program must include due diligence on the provider's own CMS, verifying their capacity to handle sensitive consumer data and their adherence to consumer protection statutes. Equally critical is the management of the consumer complaint process, which should be viewed as an early warning system rather than a nuisance. A proper complaint tracking system categorizes issues by product, branch, and nature of the grievance, allowing for root cause analysis that informs your corrective action planning. If a pattern of complaints emerges around a specific process, your change management processes must be agile enough to isolate the failure and remediate it before it impacts a larger cohort of customers. This feedback loop is the essence of maturity in any compliance program, proving to examiners that you are proactive in harm minimization. The actual adherence to the regulatory landscape requires a sophisticated approach to change management and policy documentation. As statutes are updated or new guidance is issued by supervisory agencies, your internal policies and procedures must map these changes directly to the affected business lines. This documentation should be easily accessible, version controlled, and reflective of current operational realities rather than theoretical ideals. Peer bank benchmarking remains a useful tool for evaluating whether your internal controls are keeping pace with industry best practices, though it should never substitute for a risk assessment tailored to your bank's unique profile. Furthermore, the record retention rules must be strictly followed, as the absence of a document is often treated by regulators as evidence that a required activity never occurred. By maintaining strict control over policy lifecycle and clear delegation of authority, you ensure that employees at all levels understand their specific obligations. This clarity reduces the probability of human error, which is frequently cited as a primary driver of compliance breaches. See you in the next lecture. Welcome back. Today, we are diving into the architecture of risk assessment design, a foundational pillar of any robust compliance management system. In this chapter, we will master the technical architecture of risk assessments, ensuring you can translate abstract regulatory requirements into quantifiable business logic. We will explore everything from mapping controls to board reporting metrics, providing you with the exact methodology needed to excel on the CRCM exam and in your professional practice. The design of a risk assessment starts with defining your methodology, which fundamentally requires distinguishing between inherent risk and residual risk. Inherent risk is the raw exposure of a business process or product before you apply any mitigating controls, essentially representing the threat level of an activity in a vacuum. To determine this, you must analyze geographic risk, product risk, and customer risk as variables that fluctuate based on your institution's unique operational footprint. For example, a bank offering cross-border wire transfers inherently carries a higher risk profile than a local community bank focused solely on domestic savings accounts. Once you establish this baseline, you introduce your control environment, which includes system parameters, policy documentation, and workflow controls. The residual risk is what remains after these controls are applied, and effectively calculating this difference is the primary goal of any compliance officer. In building your risk matrix, you must decide between quantitative and qualitative factors, though in practice, the most effective models utilize a hybrid approach. Quantitative indicators, such as transaction volume, complaint resolution timeframes, and historical loss data, provide the statistical validity that regulators demand during an examination. Conversely, qualitative factors allow for the subjective assessment of management oversight, corporate culture, and the effectiveness of training materials. You should map every relevant regulation against specific business units to identify coverage gaps where a lack of monitoring might lead to an enforcement action. It is not enough to simply document these processes. You must implement a system for periodic updates that accounts for changes in the regulatory landscape or internal business operations. By aligning your assessment schedule with your bank's risk profile, You ensure that high-risk areas receive more frequent oversight than lower-risk functions. Reporting the results to the board is perhaps the most critical step, as it bridges the gap between technical compliance metrics and resource allocation strategies. You need to present data that enables the board to make informed decisions about where to invest capital, whether that means upgrading automated monitoring systems or hiring additional staff to manage third-party vendor oversight. Your reporting should focus on key metrics that highlight the effectiveness of your controls, such as the results of audit testing parameters or the findings from root cause analyses of recent compliance failures. When the board understands the relationship between specific risks and the potential for consumer harm, they are far more likely to approve budgetary requests that strengthen your defensive posture. Remember that regulators expect to see evidence that your resource allocation is logically derived from these risk assessments, rather than being an arbitrary administrative choice. Quality assurance remains the final piece of the puzzle, necessitating robust sampling methods to ensure your risk assessment is not just a theoretical exercise. You should perform statistical sampling on your internal processes to verify that stated controls function as designed in reality, not just in the policy manual. This also requires keeping a close watch on peer bank benchmarking to see how your defensive measures compare to industry standards, which is a common expectation during regulatory exams. Furthermore, your complaint tracking and resolution processes provide a direct feedback loop that can identify emerging risks before they manifest as systemic failures. By documenting your workflow controls and maintaining meticulous records, you not only satisfy the letter of the law, but also build a compelling narrative for regulators demonstrating that your institution proactively identifies and mitigates risks. This structural integrity is what prevents non-compliance and makes you an indispensable asset in the eyes of executive leadership. See you in the next lecture. Welcome back. Today, we are entering a crucial chapter focused on the pillars of UDAP: unfair, deceptive, or abusive acts or practices. The Dodd-Frank Act brought clarity to the regulatory landscape by explicitly defining UDAP as a core compliance risk requiring robust oversight. This framework is not merely a list of rules, but a foundational principle that permeates every product, service, and interaction a financial institution provides. To succeed in the examination and in daily operations, you must understand the specific legal definitions that delineate what constitutes each component of the acronym. An act is considered unfair when it causes or is likely to cause substantial injury to consumers that is not reasonably avoidable by them, and that injury is not outweighed by countervailing benefits to consumers or to competition. This definition necessitates a balanced assessment, where the harm caused by a practice is weighed against the potential improvements to market efficiency or the financial benefits afforded to the customer. When evaluating unfairness, we are concerned with the net outcome of a specific behavior or policy within a bank's operational workflow. If a practice inflicts significant financial harm that the consumer cannot realistically bypass through their own actions, you are likely looking at an unfair practice. Deception involves a representation, omission, or practice that is likely to mislead the consumer acting reasonably under the circumstances. The focus here is on the perspective of the consumer, meaning that even if an institution intended no malice, the outcome might still violate the standard if a reasonable client is led to a false conclusion. Materiality is the linchpin of this definition, as the representation must be important enough that it would influence a consumer's decision or conduct regarding a product or service. Examples often include the misrepresentation of fees, the timing of interest accrual, or the scope of coverage in a protection product. If a disclosure is technically accurate, but buried in such a way that it obscures the true cost of credit, the institution risks crossing the line into deception. Assessing this requires a deep dive into your documentation, marketing materials, and oral scripts to ensure they are clear and transparent. You must constantly verify that the information provided to the customer aligns with the actual mechanics of the financial service being rendered. Abusive acts or practices are characterized by a set of behaviors that directly interfere with the consumer's ability to understand a term or condition, or that take unreasonable advantage of a client's vulnerabilities. This can occur when a consumer lacks the sophisticated understanding needed to protect their interests, or when they are unable to defend themselves due to physical or mental limitations or economic instability. Taking advantage of these vulnerabilities to gain an unreasonable economic benefit is a significant red flag for examiners. For instance, steering a client into a more expensive product without a clear justification, when it is obvious they could qualify for a better one, functions as a form of exploitation. Establishing controls involves evaluating how your staff handles interactions with customers who may not fully comprehend complex financial documentation. Organizations must implement training, monitoring, and clear policy guidance to ensure that employees focus on the client's best interest rather than solely on driving transaction volume or fee generation. A comprehensive compliance management system must treat UDAP not as an isolated monitoring requirement, but as a core component of your broader risk assessment methodology. You need to conduct regular audit testing to identify potential areas where product design or delivery might result in consumer harm. This involves collecting and analyzing data from complaint management systems to identify patterns that might indicate a systemic issue requiring corrective action. Furthermore, third-party vendor oversight is essential, as the institution remains liable for the conduct of companies that handle customer interactions or collections on its behalf. Your board reporting metrics should highlight trends in consumer complaints, resolution timeframes, and the results of quality assurance sampling. By integrating these inputs into your change management processes, you can proactively adjust policies before a product launch or a shift in regulatory expectations results in widespread consumer detriment. Penalty avoidance is a lagging indicator. The objective should be the early detection and mitigation of harm through disciplined internal controls. Statistical validity is vital when performing quality assurance on a sample of customer-facing interactions. Relying on anecdotes is insufficient. You need to leverage objective metrics that map to the probability of regulatory scrutiny. For example, comparing institutional behavior against peer bank benchmarking data helps clarify whether your practices deviate from industry standards, which could draw unwanted attention from regulators. If you find discrepancies, it is imperative to investigate the root cause and implement corrective action planning, followed by verification testing to ensure the resolution works as intended. Documentation of these processes serves as the evidentiary record during an exam, demonstrating that the institution has a diligent, top-down culture of compliance. You are building a system that anticipates risks rather than one that merely reacts to enforcement actions. Maintaining a record retention policy that preserves all relevant documentation ensures that you can substantiate your compliance posture, regardless of the time elapsed since a transaction decision was made. I will see you in the next lecture. Welcome to our exploration of Board of Directors Oversight. In this chapter, we will examine the critical responsibilities of the board in maintaining a robust and compliant institutional framework. When we talk about the Board of Directors in the context of regulatory compliance, we are essentially discussing the highest level of governance and accountability within a financial institution. The board is not merely a figurehead entity. It holds a fiduciary duty to ensure the bank operates within the bounds of the law, which includes overseeing the compliance management system. This responsibility starts with setting the literal tone at the top, which cascades through the entire organization, influencing every layer of management and staff. If the board displays a lack of concern for compliance, it is almost certain that the culture of the bank will reflect that apathy, eventually leading to risky behaviors or procedural failures. True oversight requires the board to be actively involved in the approval of compliance policies, ensuring these documents accurately reflect both the bank's risk appetite and the ever-shifting landscape of federal regulations. Without this high-level sanction, compliance officers operate in a vacuum, lacking the mandate necessary to enforce standards across different departments or business units. Resource allocation is another pillar of board oversight that cannot be delegated effectively without proper visibility. The board must ensure that the compliance function is sufficiently funded and staffed with competent personnel who possess both the authority and independence to challenge business decisions that might violate regulatory expectations. This concept of independence is frequently tested, particularly when profitable business lines are found to be skirting corners on consumer protection requirements. Establishing clear, direct reporting lines for the Chief Compliance Officer is a fundamental requirement for maintaining this independence. Ideally, the Chief Compliance Officer should have an unfettered channel to communicate directly with the board or its risk committee, bypassing layers of executive management that might have inherent conflicts of interest regarding performance metrics or rapid growth targets. This structural arrangement ensures that critical compliance failures are reported upward without dilution or delay. Reviewing audit reports and responding to regulatory criticisms constitute the reactive component of the board's fiduciary responsibilities, which are equally important as the proactive setting of policies. When examiners identify deficiencies, the board is expected to take ownership of the corrective action planning process to ensure that long-term remediation occurs rather than superficial patching. This is not about managing the day-to-day operations, but rather about holding management accountable for the timely execution of these fixes. The board must constantly verify that findings are not just addressed in a vacuum, but that the root cause analysis is conducted to prevent recurrence across the organization. By keeping a vigilant eye on audit summaries and regulatory feedback, the board forces the organization to prioritize compliance risk as an operational risk, sitting alongside financial and credit risks on their dashboard. You must also consider the board's role in monitoring internal metrics and performance indicators that act as early warning systems for consumer harm. Through the use of dashboards or regular reporting, the board should review data related to complaint tracking, resolution timeframes, and quality assurance sampling results. These metrics, when analyzed against peer bank benchmarking, provide directors with context on whether the bank is performing within industry norms or if it is an outlier that may attract regulatory scrutiny. Furthermore, board members should be well-versed in the organization's approach to third-party vendor oversight, especially since outsourcing services does not outsource the regulatory burden associated with those functions. Statistical validity in compliance monitoring and the ability to demonstrate consistent record retention contribute to the broader picture of an institution that understands its legal mandates and takes them seriously. The complexity of modern regulation, combined with the increasing speed of change management processes, means that the board must be informed and agile. They are ultimately the ones responsible for defining the institution's risk appetite, determining exactly how much compliance risk is acceptable in pursuit of business goals. If the organizational structure creates silos where information is trapped, the risk of non-compliance increases exponentially, as there is no central mechanism to ensure consistent adherence to regulations across disparate lines of business. Effective board members ask the challenging questions. How are we ensuring that training materials are current? And how do we know our controls are actually working as designed? By focusing on these high-level governance aspects, the board fulfills its duty to manage the bank's legal and reputational integrity effectively. See you in the next lecture. Welcome to this new chapter on compliance training programs, where we will explore how to build robust, evidence-based educational frameworks within a financial institution. This module is essential because a well-structured training program is your primary defense against systemic regulatory failure. Building a compliance training program requires a granular approach to identifying target audiences because a one-size-fits-all model inherently fails to address unique regulatory exposure. We begin by segmenting the workforce based on risk, which means that employees handling sensitive consumer data or processing complex loan applications require deeper, role-specific modules compared to staff and auxiliary functions. By layering these segments, you ensure that content is not only relevant, but also actionable, which translates into meaningful risk mitigation. Effective programs are built on frequency models influenced by documented risk assessments, rather than arbitrary calendar intervals. For instance, high-risk areas like anti-money laundering or consumer lending require more frequent touchpoints than administrative roles. Once the frequency is established, you must integrate training into the onboarding process to ensure that new hires are conditioned to compliance-first behaviors from their very first day of employment. The board of directors serves as the governance pillar for the entire institution, and their training requirements are distinct from those of the operational staff. Rather than focusing on day-to-day transaction processing, board training should emphasize macro-level understanding of regulatory mandates, personal liability, and the long-term strategic impact of compliance failures. You must maintain rigorous documentation for these sessions, as examiners will inevitably request evidence of board oversight during the examination process. This leads us to the critical administrative requirement of tracking completion rates and implementing an escalation hierarchy for non-completion. An effective escalation workflow should define clear consequences for missed assignments, ensuring that the compliance office does not become a bottleneck for operational discipline. If an employee fails to complete a mandatory module, the system must trigger an automatic notification to their supervisor, which provides the necessary transparency to resolve the gap without the need for manual intervention from human resources or legal departments. Regulatory flux is constant, which necessitates a dynamic process for updating training materials based on legislative shifts and agency alerts. When a regulation changes, simply adjusting the text is insufficient, as you must also assess whether the underlying delivery method remains effective or if a new approach is warranted. This involves testing comprehension through assessments that measure knowledge retention rather than just the passage of time spent within the module. Record-keeping acts as the invisible tether connecting your training activity to audit results, specifically regarding the retention of training logs, test scores, and the curriculum versions themselves. Without a centralized repository of this data, you cannot substantiate that the bank met its obligations during a peak in enforcement activity. Furthermore, these records should be periodically reconciled with your personnel databases to ensure coverage spans the entire active employee population, leaving no room for gaps in institutional knowledge. Assessing training effectiveness involves looking past completion metrics to analyze actual behavior change and potential risk reduction. It is a mistake to assume that a high completion rate reflects a high degree of compliance maturity, as completion simply proves a user clicked through the assigned material. To gain better insights, you should align training outcomes with metrics from your monitoring and auditing systems, such as observed errors in file documentation or complaints received from customers. If an area consistently shows a high number of compliance defects despite regular training, you must conduct a deep dive to determine if the material is too academic, the testing is too simplistic, or if there is a systemic issue with workflow controls. This feedback loop allows you to fine-tune your modules, making them more rigorous, where testing metrics indicate low comprehension or high error rates. Finally, ensure that your training infrastructure is adaptable enough to support broader enterprise objectives like third-party oversight and quality assurance sampling. When you engage vendors, your training program should extend to include relevant compliance expectations for those service providers to minimize consumer harm and avoid outsourced risk. By correlating complaint tracking and resolution timeframes with specific training sessions, you can perform a root cause analysis to see if knowledge gaps directly correlate to individual customer harm. This proactive management of your compliance environment establishes a clear audit trail that will serve you well during regulatory exams. You are essentially building a proactive system that treats training as a strategic risk management tool rather than a mere checkbox exercise designed for regulatory appease. I look forward to seeing you in the next lecture. Welcome to the module on third-party risk management. We will explore the rigorous standard the regulators expect when you engage service providers in today's banking environment. Third-party risk management has evolved from a simple procurement exercise into a centerpiece of supervisory expectations. When a bank decides to outsource an activity, it does not outsource the inherent risk or the legal responsibility for that activity. Regulators require a comprehensive lifecycle approach that begins long before a contract is signed and continues well after the relationship has ended. This lifecycle consists of planning, due diligence, contract negotiation, ongoing monitoring, and finally, termination. Each stage requires documentation, not merely as a box-ticking exercise, but as a demonstration that the bank understands precisely how its service providers affect its overall risk profile. You must view these activities through the lens of potential consumer harm, operational resilience, and the bank's ability to remain compliant regardless of who is performing the tasks behind the scenes. Planning must precede any procurement effort. Establishing a clear business case and identifying potential risks associated with the activity before you cast a wide net for vendors. Due diligence is the next critical phase, where you must evaluate the prospective vendor's financial health, their internal controls, their information security environment, and their adherence to legal standards. You are looking for a partner, not just a service provider, which means your due diligence must be commensurate with the criticality of the activity. When dealing with cloud service providers or fintech partnerships, this assessment becomes significantly more complex because you must understand their subcontractor arrangements and their data handling protocols. If a vendor cannot provide evidence of robust internal governance, the risk they introduce to your institution effectively becomes too high to justify the business arrangement. Contract negotiation serves as your primary legal defense, and you should never leave this to chance or generic templates. Every contract must contain specific provisions that allow your institution to maintain oversight, including the critical right to audit clauses. These clauses ensure that you or an independent third party can physically or logically inspect the vendor's systems and compliance records. Beyond the right to audit, you must establish clear service level agreements that define performance monitoring metrics. These metrics should not be passive. They need to be tied to concrete business continuity planning and operational requirements. Remember that the regulator expects you to maintain oversight of critical activities, which means your contracts must be structured to provide you with the transparency necessary to identify operational failures before they cascade into system-wide risks. Ongoing monitoring is an iterative process that requires statistical validity in your sampling methods for quality assurance. You cannot simply observe high-level performance. You must drill down into the vendor's complaint tracking mechanisms and resolution timeframes to gauge how they treat your customers. If a vendor is not conducting a root cause analysis when errors appear, they are effectively ignoring the risk of recurrence, which is a major red flag for examiners. Your monitoring program should be dynamic, incorporating changes in the legal environment, updates to the vendor's own processes, and the results of your periodic risk assessments. If the vendor's performance starts to drift, your corrective action planning must be decisive, outlining exactly how you will force a return to compliance or, if necessary, trigger a controlled termination of the relationship. Reporting metrics and board oversight form the institutional scaffolding that holds this entire structure together. Your board of directors needs to see more than just a list of vendors. They require reporting that highlights risk exposure, performance trends, and the results of audit testing. You should be benchmarking your third-party risks against peer banks to ensure your controls remain within reasonable parameters. If your policy documentation does not align with your actual workflow controls, you will likely face criticism during an examination. Regulatory enforcement actions often cite failure to manage foreign-based service providers or inadequate oversight of critical activities originating from small deficiencies that grew over time. Your compliance program must ensure that these granular details, from threshold computations to record retention rules, are treated as systemic priorities rather than departmental annoyances. I will catch you in the next session. Welcome to our discussion on audit methodologies, where we focus on the mechanics of verifying your regulatory control environment. In this chapter, we will rigorously break down the life cycle of a compliance audit, ensuring you have the technical knowledge to withstand high-stakes scrutiny. The cornerstone of any effective audit program is the independence of the auditor, which ensures that the evaluation is objective and free from institutional bias. Auditors must operate with sufficient authority to challenge existing processes, meaning they should report functionally to the board of directors or an audit committee rather than to operational management. When we define the audit scope, we establish the boundaries of what is under review, typically dictated by a risk-based approach that prioritizes areas with high regulatory impact or historical weakness. Frequency is not arbitrary. It is calibrated based on the inherent risk of the activity, the rate of change in relevant laws, and the magnitude of potential consumer harm. By focusing resources on high-risk areas, you ensure that the audit function provides the most value to the organization while identifying vulnerabilities before they manifest as enforcement actions. Moving into execution, sampling methodologies are critical because auditing every single transaction is rarely feasible or efficient. You must choose between judgmental sampling, where you select items based on known risk factors, and statistical sampling, which provides a mathematical basis for extrapolating findings across a population. Once a sample is selected, we move to transactional and control testing to determine if your documented policies are actually functioning in practice. Transactional testing checks the individual outcome against regulatory requirements, whereas control testing examines the design and operating effectiveness of the governance framework itself. If a control fails, your documentation must precisely capture the deviation, which brings us to root cause identification. You are not only looking for the immediate error, but also for the systemic failure that allowed the error to occur, whether it be a system parameter configuration issue, a lack of training, or a flawed policy design. Management responses to these findings must be substantive, incorporating corrective action plans that address the underlying root cause rather than merely patching the symptoms. The audit work papers serve as the essential, legally defensible record that demonstrates the audit was conducted according to established procedures and standards. These papers should tell a clear story, documenting the methodology, the testing performed, the identified exceptions, and the eventual resolution. Reporting this information to the audit committee requires distilling complex technical data into actionable board reporting metrics that highlight compliance trends and systemic risk. A robust issue tracking and validation process ensures that when an auditor identifies a deficiency, the organization does not simply file the report away. Instead, it enforces accountability by tracking the remediation until the control is confirmed as effective. In the broader context of governance, external auditor selection and peer review mechanisms serve as a check on your internal processes, offering a third-party perspective on your audit quality. Your program should also account for third-party vendor oversight, which is often a significant blind spot where compliance obligations are delegated, but the risk remains with the bank. When addressing complaint tracking and resolution timeframes, the auditor should look for statistical validity in how data is aggregated to ensure that the bank is not minimizing the severity of systemic trends. Change management processes are another vital area. When you update system parameters or roll out new products, the audit must verify that compliance guardrails were effectively integrated during development. Record retention rules must be strictly adhered to throughout this lifecycle to prevent gaps in documentation that could lead to penalty assessments or enforcement action during a formal exam process. See you in the next lecture. Welcome to our discussion on compliance monitoring systems, where we will examine the mechanisms required to ensure ongoing adherence to regulatory standards. We will shift our focus from static processes to the dynamic, continuous monitoring that defines a robust compliance environment. In any well-structured compliance program, the distinction between the first and second lines of defense is fundamental to maintaining operational integrity. The first line of defense consists of the business units themselves, who own and mitigate the risks inherent in their day-to-day operations. This line relies heavily on quality control, which involves the preventative checks built directly into workflows to catch errors at the point of origin. Conversely, the second line of defense provides independent oversight through quality assurance, which acts as a retrospective validation of the first line's controls. While quality control prevents the fire from starting, quality assurance acts as the smoke detector that monitors whether the suppression systems are actually working as intended. By separating these duties, an institution creates a system of checks and balances where no single unit is responsible for both execution and unchecked self-validation. Effective monitoring relies on the transition from ad hoc manual reviews to automated exception reports that capture irregularities in real time. These systems function by flagging transactions or accounts that cross predefined system parameters, which then allows for immediate intervention rather than retrospective cleanup. To make this data meaningful, compliance officers utilize key risk indicators, or KRIs, which quantitatively measure the level of risk exposure at any given moment. Complementing these are key performance indicators, or KPIs, which track whether the business is meeting its internal efficiency benchmarks alongside its regulatory requirements. When this data is visualized through a centralized dashboard, management can perform trending analysis to identify if a localized issue is actually a symptom of a broader, systemic failure. This transition from reactive firefighting to proactive, data-driven oversight is what differentiates mature programs from those merely checking boxes. Systemic issues often hide in the margins of daily activity, requiring targeted reviews to expose hidden compliance vulnerabilities. When these reviews uncover recurring failures, such as consistent errors in consumer privacy disclosures or incorrect threshold computations for fee assessments, they must be formally escalated to the board for immediate remediation. Board reporting metrics serve as the primary communication vehicle here, distilling dense regulatory concepts into actionable intelligence that shows both the current state of policy adherence and the trajectory of potential risk. If the data shows a spike in consumer harm or a pattern of regulatory misalignment, the escalation process moves from informational reporting to mandatory corrective action planning. This cycle of monitoring, escalating, and planning forms the bedrock of an institution's proactive stance toward avoiding civil money penalties. Beyond internal monitoring, institutions must maintain rigorous oversight of third-party vendors, as an external provider's failure is an internal compliance failure for the bank. This oversight starts with a clear understanding of the vendor's control environment, supported by regular quality assurance sampling to ensure their data remains within the bounds of statistical validity and the original contract terms. Furthermore, internal complaint tracking should be viewed as a vital data stream, not just a customer service metric. By analyzing resolution timeframes and the root cause of every filed complaint, a compliance officer can spot early warning signs in products or services that may inadvertently violate federal law. This methodology is particularly relevant in the context of change management, where any shift in product offerings or internal policy must be analyzed for its potential impact on existing system parameters. Ultimately, the goal of these monitoring systems is to provide a defensible record of compliance, which is essential during an examination. This involves documentation not only of the policies in place, but also of the enforcement action precedent analysis used to calibrate the bank's risk appetite relative to peer bank benchmarking. By maintaining a robust audit trail, a bank demonstrates that its record retention rules are consistently applied and that its quality assurance processes are genuinely independent and rigorous. If a regulator questions the efficacy of your program, your ability to point to historical monitoring data, clear corrective action plans, and ongoing system testing is your strongest evidence of a functioning compliance management system. This structure holds the institution accountable to its own standards while providing the agility needed to respond to the evolving regulatory expectations of federal agencies. We will see how these components interact in our subsequent session. Welcome back. Today, we are exploring the strategic importance and operational mechanics of complaint management systems within a robust compliance framework. This chapter covers the end-to-end life cycle of customer grievances, from initial intake to regulatory reporting and board-level oversight. A functional complaint management system acts as the institution's primary sensor for identifying systemic failures and potential UDAP risks. When a customer registers a grievance, whether through a phone call, email, or a direct submission to the CFPB portal, the institution must treat this as a structured data point rather than an isolated incident. The system should normalize these inputs across all channels to ensure that a social media mention receives the same level of scrutiny as a written letter. By categorizing these complaints based on product type, regulatory violation, and functional area, the bank creates a repository of institutional memory. This is not merely about service recovery, it is about aggregating data to detect patterns that could signal a broader breach of consumer protection obligations. Without this centralization, banks often fail to see the forest for the trees, missing the early indicators of a high-risk activity that eventually garners regulatory attention. Investigation and root cause analysis form the core of any defensible system, requiring a methodology that moves beyond surface-level resolution. When a complaint is received, the investigator must ascertain if the issue stems from a breakdown in policy, a failure in third-party vendor oversight, or a deliberate design flaw in a financial product. This process necessitates a deep dive into the underlying data, often requiring cross-departmental collaboration between operations, legal, and compliance teams. If the investigation reveals actual or potential consumer harm, the bank must promptly establish a remediation plan to make the affected parties whole. This step is critical because regulators consistently evaluate the adequacy of the refund process and the speed at which the institution identifies and addresses harm. If the issue is persistent, the system must trigger a change management process to update workflows or controls to prevent recurrence. Tracking, trending, and reporting create the feedback loop necessary for the board and senior management to exercise effective oversight. These stakeholders do not need to review every individual complaint, but they must have visibility into the metrics that define the health of the compliance program. Key indicators include volume trends, resolution timeframes, and the breakdown of resolved versus pending issues. Reporting should highlight emerging risks gathered from complaint data, such as a localized spike in errors related to a new product rollout or a specific branch's service failures. Furthermore, benchmarking these results against peer banks can provide valuable context during regulatory exams. When the board reviews these reports, they are performing a vital function in the compliance management lifecycle, ensuring that the institution maintains risk appetite boundaries and allocates sufficient resources to address identified vulnerabilities. Regulatory portals and the management of formal inquiries require a distinct, highly disciplined approach to communication and data retention. When the CFPB or another regulatory body forwards a complaint, the regulatory requirement is often a tight turnaround, making administrative precision the difference between an acceptable response and a potential enforcement action. Each response must be backed by evidence, including internal logs, transaction records, and a justification for the position taken by the bank. Consistent documentation across all phases of the complaint lifecycle is essential for auditability and for building a historical record that demonstrates good faith. Examiners will test the statistical validity of your complaint data, looking for evidence that the institution does not merely dismiss complaints, but actively uses them for corrective action planning. This high level of attention ensures that the bank remains proactive rather than reactive in the face of supervisory scrutiny. Statistical validity and reporting relies on the consistent application of quality assurance and defined threshold computations. It is insufficient to record complaints randomly. The bank must employ standardized parameters that define exactly what constitutes a complaint versus a routine service inquiry. This distinction prevents the dilution of data and ensures that the institution's risk assessment methodologies are grounded in accurate, comparable metrics. By maintaining rigorous record retention rules and ensuring that every closed complaint has an archived audit trail, the bank creates a defensible position in any subsequent enforcement action. This is the bedrock of compliance. If a regulator asks why a specific process remained unchanged despite trends suggesting harm, the bank must be able to pull the reporting logs and the board meeting minutes demonstrating full awareness and remedial efforts. Following this approach creates a culture of accountability that permeates the entire service architecture. I will see you in the next lecture. Welcome to this chapter on regulatory examination preparation, where we will demystify the process of governing interactions with supervisory bodies to ensure your institution remains resilient. By the end of this module, you will understand how to manage the life cycle of an exam, from the initial scoping letter to the final resolution of any identified concerns. Preparing for a regulatory examination is an exercise in disciplined communication and rigorous document management. It starts the moment you receive a scoping letter, which formally notifies the institution of the agency's intent to inspect specific areas of the business. You must treat this document as the master roadmap for the entire engagement. Establish a dedicated staging area, whether digital or physical, where all requested artifacts are centralized and reviewed for accuracy before being submitted to the examiners. This prevents the haphazard release of information and ensures that the narrative provided to the regulators remains consistent and grounded in verifiable policy. Effectively managing these interactions requires designating a single point of entry to oversee requests, as this minimizes the risk of providing contradictory information or redundant data. Think of this as maintaining a clean dependency graph. You want to ensure that every piece of data provided has a clear, audited source and is contextualized by the relevant internal policies and workflow controls. The daily rhythm of an examination is defined by proactive communication. Daily meetings with the examination team are not optional, as they serve as the primary mechanism for clearing up potential misunderstandings before they spiral into formal findings. If an examiner requests clarification on a calculation or a specific data point, address it immediately rather than waiting for the next cycle. Miscommunications in these moments often arise from a simple disconnect between how a bank defines a metric and how the examiner expects to see it derived. By staying ahead of these queries, you significantly reduce the likelihood of seeing these issues evolve into formal matters requiring attention, commonly known as MRAs. If you find yourself in a situation where a disagreement persists, do not escalate unnecessarily before exhausting your internal facts. Document the conversation, confirm the interpretation of the regulatory guidance, and ensure you have your audit testing and risk assessment data ready as a defense for your organization's methodology. When an exam concludes, the process is far from over. The exit meeting is your final opportunity to discuss the preliminary findings and ensure there is a clear understanding of the agency's perspective. If you are presented with an MRA, a supervisory letter, or, in more severe cases, a memorandum of understanding, you must treat these as critical signals that your compliance risk management framework requires recalibration. Responding to these documents requires precision. You must outline a corrective action plan that addresses the root cause rather than merely patching the symptoms. Enforcement actions are rarely arbitrary, so conducting a thorough analysis of the examiner's observations against your own existing internal controls is essential. If the bank truly believes a finding is factually incorrect or inconsistent with prevailing supervisory guidance, the formal appeals process is a route available to you. However, approach this with the understanding that an appeal should only be pursued when you possess overwhelming evidence of regulatory misapplication, as the goal is always to demonstrate a robust and self-correcting compliance culture. See you in the next session. Welcome. Let us discuss how to effectively engage with regulatory bodies such as the Consumer Financial Protection Bureau. In this lesson, we will examine the mechanisms, expectations, and strategic considerations required for high-stakes interactions with federal examiners. Navigating interactions with the CFPB requires a clear understanding of the agency's supervisory reach, which spans large banks, non-bank entities, and other financial service providers. The CFPB Examination Manual serves as the primary roadmap for examiners, outlining the specific areas of focus during a review. When you are undergoing an exam, the examiners essentially test the integrity of your compliance management system against these established protocols. You must understand that examiners rely on risk assessment methodologies to allocate their resources, meaning they will focus their energy where they perceive the highest potential for consumer harm. Being prepared means having your audit testing parameters, policy documentation, and workflow controls clearly aligned with the expectations set forth in the manual. If you have not performed a rigorous self-assessment beforehand, you will struggle to provide the transparency that leads to a smooth examination process. Supervisory highlights and public registry data often serve as early warning systems for the current priorities of the regulator. By monitoring enforcement actions and published advisory opinions, you can calibrate your internal controls to address emerging risks before an examiner arrives at your doorstep. For instance, the CFPB utilizes civil investigative demands, often referred to as CIDs, to gather information during investigations, which often precedes formal enforcement activities or administrative adjudications. Dealing with a CID is not a routine matter. It requires immediate legal involvement and a precise, comprehensive response strategy to avoid escalating the matter unnecessarily. You should treat these demands as a signal that your internal monitoring systems, specifically your complaint tracking and resolution timeframes, are being scrutinized for evidence of systemic failure. Effective oversight ensures that you can demonstrate proactive remediation rather than reactive damage control. Managing the flow of information during an examination is as much about quality assurance as it is about data accuracy. Regulators will demand statistical validity in your sampling methodologies, meaning you cannot simply provide arbitrary datasets to prove compliance. If you are asked to provide records regarding consumer harm minimization or third-party vendor oversight, the information must be backed by documented evidence and sound logic. You should maintain a record retention system that allows you to retrieve, verify, and present documentation on demand without creating additional risk. Furthermore, your board reporting metrics should transparently display that management is informed and active in the governance of these compliance issues. When auditors or examiners identify a gap, having a robust corrective action plan already under development shows that your change management processes are functioning as intended. The rulemaking process and the various guidance documents released by the Bureau are not merely suggestions. They are the benchmarks against which your operations will be measured. Sometimes, you may find yourself navigating nuances in the law, where trial disclosure programs or no-action letters might offer a defined path for innovation. However, these are narrow exceptions and should not be confused with a general flexibility in regulatory enforcement. Your goal is to establish a system where penalty avoidance is a natural byproduct of your operational design, not a desperate scramble. This requires regular root cause analysis of every consumer complaint and a clear, auditable trail of how those issues were resolved. By focusing on these quantitative and qualitative metrics, you shift the narrative of your interaction with regulators from one of defensive posture to one of transparency and professionalism. See you in our next discussion. Welcome to the chapter on managing enforcement actions, where we will examine how regulators exercise authority when banks fall short of prescribed standards. We will walk through the mechanisms regulators use to address non-compliance and the internal controls necessary to navigate these risks effectively. In this series, we will dissect the relationship between safety and soundness oversight and consumer compliance expectations. When we talk about prudential regulators like the FDIC, OCC, and the Federal Reserve, we are looking at institutions that maintain the stability of the financial system through a defined supervisory lens. The CAMEL's rating system remains the backbone of this oversight, evaluating capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk. However, your role as a compliance manager requires a sophisticated understanding of how these ratings intersect with the consumer compliance rating system. This specific system, which also uses a 1 through 5 scale, reflects the strength of your bank's compliance management system in preventing consumer harm and ensuring adherence to federal consumer protection laws. When a deficiency is identified, the regulator moves from routine supervision into formal or informal enforcement oversight. Enforcement actions serve as the regulatory apparatus for correcting significant failures in internal governance. The spectrum of these actions ranges from informal supervisory letters, such as memoranda of understanding, to formal orders like cease and desist orders. A cease and desist order is a significant intervention that requires a bank to stop an activity or take specific affirmative actions to achieve legal or regulatory compliance. Alongside these, regulators maintain the authority to impose civil money penalties, which are calculated using a specific matrix that considers the severity of the violation, the bank's history of non-compliance, and the presence of any financial loss or consumer harm. Furthermore, regulators may issue removal and prohibition orders, which effectively bar specific individuals from participating in the affairs of any insured depository institution. These powers are not theoretical, but represent grounded administrative realities that arise when a bank's risk assessment methodologies or board reporting metrics fail to capture emerging hazards or patterns of noncompliance. Managing these high-stakes situations requires a rigorous focus on quality assurance and internal controls. The Prompt Corrective Action Framework, for example, mandates specific interventions based on a bank's capital category, forcing the institution to act before the situation deteriorates further. To manage these risks, compliance officers must integrate robust record retention rules and formal change management processes into their daily operations. If an enforcement action is initiated, regulators will look for a detailed history of your complaint tracking and resolution timeframes to determine the scope of systemic failure. Often, a root cause analysis is the first step in creating a credible corrective action plan that regulators will accept as a roadmap to restoration. You should treat your policy documentation not merely as a compliance exercise, but as a strategic shield that demonstrates proactive oversight rather than reactive scrambling. Successful navigation of such regulatory scrutiny relies on your ability to implement statistical validity within your monitoring programs. When auditors or regulators review your compliance program, they will look for rigorous sampling methods that demonstrate you have tested your controls across the entire population of relevant transactions. Peer bank benchmarking is a helpful tool here, as it provides a baseline to determine if your controls are reasonable given your institution's size and complexity. Third-party vendor oversight is another critical vector, as the regulator holds the bank responsible for the actions of its service providers regardless of the contract language. If you have clear, tested threshold computations for reporting potential issues to the board, you significantly reduce the risk of an enforcement action escalating into something more severe. The goal is always to minimize the window where consumer harm can occur and to document every remediation step with absolute clarity. See you in the next lecture. Hello there, and welcome to this final module of our course. We are now at the stage where we consolidate everything we have discussed regarding compliance management, regulatory mandates, and operational oversight to prepare you for the certification exam. In this section, we will synthesize the vast landscape of banking regulations across all domains, including lending, deposits, financial crimes, and information security. The CRCM exam is not merely a test of rote memorization, but a rigorous assessment of your ability to apply complex statutes to practical, ambiguous scenarios. We will review how to manage risk assessments, interpret supervisory guidance, and align your compliance management system with enterprise-wide strategic goals. You should expect to see questions that bridge the gap between abstract policy documentation and the gritty reality of audit testing parameters and corrective action planning. By shifting our perspective toward the examiner's mindset, we can better identify the core issues within a hypothetical bank's procedures, whether that involves third-party vendor oversight, statistical sampling, or record retention rules. Effective test-taking strategy requires a disciplined approach to managing your time and anxiety during the actual examination environment. Many candidates fail not because they lack technical knowledge, but because they struggle to navigate the specific question formats or become overwhelmed by the sheer volume of regulatory detail. I recommend that you focus on identifying the intent of a question first, which often involves filtering out extraneous information designed to distract you. Practice your ability to recognize trigger keywords associated with specific statutes, such as those related to consumer harm, penalty avoidance, or specific threshold computations. When you encounter a challenging scenario, think about the underlying root cause analysis that an examiner would perform when auditing a particular workflow control. This methodology ensures that you remain objective and structured, even when the pressure mounts near the end of the testing period. Identifying your weak areas is a critical step that requires a brutally honest self-assessment of your performance during practice drills. If you find yourself consistently stumbling over specific timing limits, such as those found in deposit account regulations or credit disclosures, you must isolate those variables for focused review. Consider using a matrix to chart your progress across different domains, noting where your accuracy dips and where you spend the most time hesitating. Sometimes we harbor unconscious biases toward the domains we deal with daily, which can lead to overconfidence in those areas and neglect of less familiar topics like third-party risk management or AML enforcement actions. Use this final phase to force yourself to engage with the modules you find most tedious, as these are often the areas where the most points are won or lost during the exam. Beyond technical knowledge, maintaining your certification requires a commitment to ongoing regulatory change tracking and professional development. The landscape of compliance is dynamic, and your ability to adapt to new supervisory guidance is just as important as knowing the legacy statutes. Once you pass the exam, the focus shifts to internalizing the habits of a successful compliance officer, such as maintaining rigorous policy documentation and fostering a healthy collaborative environment with various lines of business. Remember that the ultimate goal is not just to pass a test, but to build a robust framework that minimizes consumer harm and ensures the long-term viability of your institution. Continue to apply these frameworks in your daily work and treat each regulatory update as an opportunity to refine your internal controls and testing procedures. I look forward to hearing about your success on the certification exam.